crucial as an 1/1/2021 was already over. Now ICA is the thought of considering extension of the time to appoint that paid assistants for the next coming year audits eligibility. My other submission to the members at this junction, I need to bring the members notice also. ICI has taken wonderful initiative for the welfare of the CA student fraternity, that is the regarding to medical insurance for the health of CA students. I request all the members, especially practicing chartered accountants, because of the most of the article students and staffs are participating in the bank audits to safeguard their health and the scenario of the COVID. ICA has tied up with the New India Insurance Company, offering health insurance at a very nominal discounted price around 1,500 rupees, which covers almost 2 lakhs for every student to meet these hospital expenses, including the COVID. I request to take the insurance policy for all the staff members to avoid the huge medical expenses. With this brief address, thank you for the members giving this wonderful opportunity.
Thank you, Mastan sir. Now I am requesting our Central Council member from Hyderabad, CA Dayanivas Bhai Sharma, to give his valuable address, please.
Thank you, Secretary Satish. Good morning, the respected Chairman of Hyderabad branch, my regional council members, but more importantly, the Vice Chairman of SIRC. Mastanji, namaskar to you. And thank you very much for giving an insightful speech from your side. And Naresh Bhai and Changal, thank you very much for being there. And the Vice Chairman, Secretary, all, I'm just talking in one shot. But more importantly, Dhananjay sir, thank you very much for being part of Hyderabad, team today. And your speech is going to be for the first time in Hyderabad, and we all have heard about you in a larger, respect at the national level, which has been a great thing. Just only one thing which I would like to say is tomorrow I am a speaker, so I'll talk in detail tomorrow because 9:45. is a time where our speaker had to speak, and I'll respect his time because we have called him from a different location. I'll just restrict my today's discussion and ensure that tomorrow we have. I'll give my feelings expressed in my way, and we'll have a detailed discussion tomorrow. Dhananjay, thank you very much for coming in. Really admiring and looking forward to listen to you, and let's make it going forward. I wish you all a great learning, and tomorrow we'll discuss in detail about the topic. Thank you very much.
Thank you, Daya sir.
Thank you, Daya sir.
Welcome, Dhananjay sir, and thanks for accepting our invitation and coming here. Over to Secretary.
Yeah, thank you, Chairman sir. On behalf of Hyderabad branch of SIRCF ICIA, I thank CA Machara Nimali, Hyderabad branch chairman, CA Dayanivas Sharma, Central Council from Hyderabad, our today's speakers, Dhananjay sir, CA Moniji, and Chairman Vice Chairman Singal Reddy Garu, and Deepak Bhai Ledda, Rajambal, Pankaj Bhai Trivedi, Banu sir, ACS sir, for all other members for joining this inaugural session. I hope our members will get benefit from this today's seminar by listening from all the speakers. With your permission, I am concluding this session, sir. If you permit, we will start our first technical session.
Please, Satish Garu.
Thank you, Chairman. Yeah, I welcome all the members for the first technical session on IRAC norms under COVID-19 circulars, restriction of advances, and other important circulars during the year. And I welcome CA Dhananjay Gokhale sir from Mumbai. Today is our first section speaker. I request Deepak Bhai Ledda to introduce today's speaker, please.
Thank you, Satish sir. Good morning, all the dignitaries on the screen and all the members. It is my immense pleasure to introduce the renowned speaker, CA Dhananjay J. Gokhale sir. C. Dhananjay J. Gokhale sir is a Bachelor of Commerce from University of Mumbai and a fellow member of ICAI with over 24 years of post-qualification experience. He is also Information System Auditor qualified. He is a founder partner of the firm Dhananjay J. Gokhale and Company, Chartered Accountant, specialized in providing management consultancy, auditing and assurance services in corporate and banking sector. He was a co-opted member of Auditing and Assurance Standard Board of ICAI for the financial year 18-19 and was nominated as a subgroup member of Banking, Insurance and Pension Committee of WIRC of ICAI for the year 18-19. He was convener of the study group formed for ICAI Guidance Note on Audit of Banks for 2019 edition. He is a member of expert panel constituted by AASB of ICAI for addressing the bank audit queries of the member since financial year 11-12 till date. He has authored articles in ICAI Magazine, ICAI Guidance Note on audit of banks for the year 2016 to 2021 editions continuously for the last 5 years. He has authored on various articles on manual on concurrent audit of banks, reference material published by WIRC on statutory bank audit, and background material for executive master programs for new age auditors by Center of Audit Quality, that is CAQ of ICAI. He has handled variety of assignments related to arena of bank audit, including statutory central audit of public sector banks, merger and acquisition of urban cooperative banks, and consultant to board of banks. His regular speakers are various seminars on standards on auditing and bank audit at various regions and branches of ICAI. He has been a regular speaker at staff training seminars organized by public sector, private sector, and urban cooperative bank and association of banks. He has also been a visiting faculty at University of Mumbai. With this, I present C. Dhananjay J. Gokhale sir before the August audience.
Thank you, Chairman Deepak. Sir, now the screen is yours, Dhananjay sir.
So, Satish Garu, we recognize the presence of Moni sir also. The second,
Introduction of Moni sir also?
no. Moni sir also joined.
Yeah, second session should be introduced thereafter. Yeah. We are recognizing the presence of CA Moni sir, our second session speaker. Welcome, sir.
Welcome, sir.
Over to Dhananjay, sir.
Yeah, over to you, sir.
Thanks a lot for the introduction, and special thanks to CCM Dayaniva Sharma, because we had a talk almost a month back. Unfortunately, we are not able to meet physically because of the recent surge in COVID cases. But still, nevertheless, it's been always pleasure to accept the invitation from Hyderabad, which I missed out in last couple of years because of clashing of dates. And I was talking with Chairman sir about my closeness to Hyderabad. In fact, we had a long talk about that. We had been central auditors for SBH, so Hyderabad is very close to me by all means. And in fact, I was looking for an opportunity to again visit there and catch up with many people who are there in Hyderabad who know me personally, rather than on a professional front. But maybe whenever the next opportunity comes in, I already promised to Chairman that on my own I will contact him and will make it a point. Just few things actually which I just wanted to discuss. Just before that, can you enable my screen share? I think because it's not yet shared with me. Okay, yeah, now it's enabled. Yeah, just a minute. I think it's visible to all. Just 2 minutes I will take about a few things which I just want to supplement to Vice Chairman sir of SIRC about the bank audit and other things. In fact, I'm not criticizing anything about that, but I just thought that I will just throw some light, more light about bank audits. See, first thing is that as a CA firm, we need to prepare ourselves to face a situation wherein the firms are not really dependent on bank audit, because what is happening today is that it's a kind of presumption which all of us are having that we'll get bank audits, and that's a kind of assured business or assured professional practice area which we are having. That is something which may not really sustain in a on a long term basis. Just like if you compare the income tax practice has changed a lot. We need to brace up ourselves about automation of income tax returns, faceless assessment. So similar to that, bank audit, what we are looking today may not really sustain, in the same manner in future. Second thing is that, as all of us were rightly discussing that when March month comes up, everyone starts preparing for the bank audit. That is something which is a kind of a dangerous thing. We need to keep on learning throughout the year because RBI has been coming out with dynamic circulars. Even to digest a circular, it typically takes time actually. Like just to give an example, like Supreme Court judgment, which was delivered 3 days back, which has practically squashed the earlier interim order of Supreme Court. That itself is running into 148 pages. I really doubt whether any member is really taking pain to read those 148 pages, and typically everyone gets at the end and sees what is the bottom line. And we may miss out on certain areas when we do that. Another point is that see, bank audit is a kind of a specialized job and not a generic practice. For example, suppose I'm doing a GST audit, I always check it with myself that whether I'm aware about GST laws or not. And if I happen to get a GST audit just because of empanelment, and if I don't practice GST in on a regular basis, there is a kind of risk which we are posing on ourselves. So just introspect about that aspect. Last point was about category 4 firms and proprietorship firms. I am not really getting into debate about that, but only my one simple request is that introspect yourself about what is the capacity of your firm. If you're lacking somewhere, start on capacity building at right time rather than thinking about how to comply with the provisions of empanelment. Frankly speaking, suppose we just take an example of a proprietor firm wherein we don't have that capacity to do an audit. It's a little dangerous to sign off 3 balance sheets, like 3 branches audit, because bank will never do a distinction between category 1 and category 4 auditors, and they will allot 3 branches. So ask yourself whether you are having that capacity or not. And if something is not there with us, we can always say no, because issue with all of us, including myself, is that we have never taught or we have never thought of saying no to our clients. So whatever comes, actually we keep on accepting that without thinking that whether we can stretch ourselves to that extent or not. So I just thought that I will just spend 5 minutes, again, not to criticize any views. I respect everyone's views, but just I thought that I can share this with views with all of you. As far as today's topic is concerned, even though I will be talking on IRAC norms, I will be focusing more on the COVID-19 circulars, and as much as possible, I will try to give the maximum examples at each occasion. And I can see the chat box which is open. So what I suggest is that in physical mode, we can always afford to have a kind of interaction, but in virtual, it becomes a little restrictive thing. So if anyone has any queries, they can post in chat box also. I will try to answer the queries at that point. Yes, Sharman sir.
Dhananjay sir, small request. Any questions they can put in Q&A, sir.
Fine, I will keep Q&A open.
We follow the practice in Hyderabad.
The only reason why I was saying that we can have interaction is that many times a particular topic is going on and it becomes very easy and relevant whenever I answer that query. So I'm keeping question answer menu also open. So just an appeal to all the audience. Feel free to ask any question. And that's the only way to make it a virtual session interactive rather than a monologue wherein I shouldn't get a feeling of a newsreader wherein I just keep on talking to all of you. These are the points which I intend to cover throughout the session. Few things in case if I'm not able to cover, I will be sharing this PPT, which is an exhaustive one. It's a bigger PPT because few things I have written in the PPT, even though they are not relevant for 2021. But suppose you are looking at some earlier loans which have been maybe restructured under S4A or SDR, then I have kept those PPT slides as a point of reference so that it becomes easy. So initially we'll talk a little about objective of IRAC norms. Then we'll talk about what are the norms which RBI specified about identification of accounts as NPA. Then we'll talk about certain exceptions and clarifications related to IRAC norms which RBI has given in the circular. And then we'll come to MSME circular, that is the 6th August circular, and that 6th August circular is continued circular of February 20. And then we'll talk about COVID-19 related circulars at length. So we'll cover all the circulars starting from 27th March 2020. And then we'll talk in brief about projects under implementation and the concept of restructuring of advances. June 19 circular, even though I'm having detailed slide presentation over here, I will just touch upon that for the simple reason that June 19 circular is applicable only for advances which are having exposures above 1,500 crores. So typically, very few of us might be really facing that kind of a scenario, because in most of the branches, advances, the borrower exposure may not be to that extent. And all the accounts which are having exposure below 1,500 crores, this circular is not really applicable. To begin with, I just want to give a kind of reference to few circulars which you need to keep it handy whenever you are doing an audit. So the first circular is the IRAC circular which we are having. That is July 15 master circular. So that's the starting point which you need to have. Second one is master direction related to relief measures by banks in areas affected by natural calamities. That is agriculture advances related circular. So wherever you are doing agricultural based branch, this is circular which you need to keep it handy with you. Then we have June 2019 circular, which was issued in dispensation of February 18 circular, because February 18 circular got stayed by Supreme Court order. And then we have a series of MSME one-time relief circulars which started from February 18. It was supplemented by June 18 circular. Then it was extended further by January 19 circular. January 19 circular got extended by February 20 circular. And at present, we have the last circular of 6th August 2020. As far as COVID circulars are concerned, the first circular got issued on 27 March 2020, almost exactly a year back. Then there was a circular which was added up, that is 17th April circular, because 27th April March circular didn't give any, you can say, a relaxation about asset classification norms. So 17th April circular was basically to give that relaxation. Then 27 March and 17th April circular got extended by 23rd May circular, that is 23rd May 2020 circular. After that, there was 6th August 2020 circular, which is a resolution framework for COVID-19 related stress accounts. Just to put it in simple words, this is a circular wherein restructuring of advance accounts is has been made available to the accounts which have got affected by COVID-19 pandemic. And the benefit given is the retention of class of asset. Then we have 17 September 2020 circular, which gives financial parameters to analyze whether any resolution framework under 6th August 2020 circular is viable or not. And then we have 13th October 2020 circular, which is in the form of FAQs which RBI has published. So firstly, we'll just have a kind of a brush up about the present IRAC norms. So as far as RBI's view is concerned, what RBI has been harping upon since long is that the classification of advances which the bank is supposed to do has to be done on the basis of an objective criteria. So RBI is very categorically clear that the criteria under which the classification of advances will happen is required to be an objective one. In short, there is no scope for any subjectivity which is expected from regulator side. And once a bank adopts a objective criteria, that is required to be applied in a uniform and consistent manner. What it really means is, one is not supposed to make any distinction between two borrower accounts, irrespective of their background, their credit rating, maybe their reputation in the market, or also the security cover which they are offering. So the criteria has to be uniform and consistent. When we talk about provisioning part, provision has to be made on the basis of a couple of criteria. So first thing is that as far as the provisioning is concerned, first we need to analyze as to what is the basis of classification of accounts. So the classification once the bank does on a objective basis. Secondly, you need to look at what is the classification. So broadly, it will be between standard and NPA accounts. So if an account is NPA, then we have to verify as to what is the period for which the asset has remained in non-performing asset category. So for first 12 months, it will be under substandard category. Next 12 months, it will be under a doubtful 1 category. Then we have for 2 years, it will remain in DA2 category. And then it will slip to DA3 category. In between the period, if the banker or if the regulator or the auditor is of the opinion that out of particular NPA account, there is no amount which is likely to be recovered, then that can be classified under loss asset category. Once you classify an account under NPA category, next thing you have to check is what is the whether the security is available or not. And if the security is available, what is the realizable value of that particular security? So depending upon the realizable value of the security, your provisioning requirement will change, which is coupled with what is the classification of under NPA category. Now, broadly, as you are aware, that the assets are divided into types. One is performing asset, second one is non-performing asset. As far as performing asset is concerned, the performing assets are those which are not non-performing asset. That is the simplest definition which I can talk about. As far as the other definition is concerned, this is the asset which is not carrying the risk which is more than normal banking risk. Now, this is a more fundamental definition of a standard account. Now, as compared to that, non-performing asset is one which is carrying a risk which is higher than normal banking risk. Now, let me just talk a little more about that. Now, what is normal banking risk? Normal banking risk is the one which any lender will have whenever the lending business starts. So, suppose as a person you have lent certain money to say XYZ person, then there is a risk of non-realization of the fund which you have lent. So, that is called as normal banking risk. So anything higher than that, that will be called as a higher risk than normal banking risk. So let me just give you a couple of examples. Let's presume that we are having a project loan. So as all of you are aware, for project loan, the bank is required to mention a DCCO, that is date of commencement of commercial operation. Now, whenever the DCCO is mentioned, what is expected is the commercial activities in that particular project loan, that is the project needs to start by that date. So it might happen that the commercial operation do not start by DCCO. And even though the account might be a normal account, in the sense there are no overdues in that account on that particular date. But since the commercial operations haven't started off, still, in spite of not having that account under overdue status, still the account will be required to be categorized as NPA because there is a higher risk which is involved over there. Let me give you another example. That suppose we are having a property which is mortgaged with the bank, and against the property, the bank has lend certain money, maybe OD against property or maybe term loan against property. Now, the bank is having a practice of periodic revaluation of that particular property, and on that basis, actually, the bank has again, valued that property. And in the recent valuation, it is observed that the value of the property has deteriorated beyond 50% as compared to the earlier value. So let's say earlier value was at 10 crores. Now we are having a valuation report of 4.5 crores. So there is a deterioration beyond 50%. But otherwise, the account is normal. So in that case, since the higher risk is now involved because of exceptional deterioration in the value, the account will be required to be marked under doubtful asset category without having any other delinquency. So account otherwise is normal, but since there is a higher risk involved, the account will get marked as NPA. So I just thought that just to give two examples to demonstrate before you as to what is meant by higher risk. Other two criteria are that if a account ceases to generate an income for the bank, then that account will be marked as NPA. And that is the second criteria, is that there are various criteria which are defined by RBI based on type of advances. So if any of the criteria gets fulfilled, the account is required to be marked as NPA. So in next couple of slides, we'll try to analyze as to what are the various criteria which RBI has defined. So let's start with the first one. We'll start with term loan account. So as far as term loan accounts are concerned, in case if interest or installment, if it remains overdue for a period of more than 90 days, then that account will be marked as NPA. Now here actually the most important primary condition is that the account has to be overdue. And if the account is overdue, then in that case, you need to test that whether the overdue portion is outstanding for more than 90 days or not. So now how to calculate overdue? The simplest method is that you have to compare the ideal DP as on a cutoff date with the ledger outstanding balance on the same date. And the differential between that, if it is adverse, then the account will be called as overdue. So if your ledger balance is more than ideal DP, the account is said to be an overdue account. Now, once the account is overdue, calculate the difference between these two, divided by EMI, presuming that it's a EMI based loan. So if your number of EMIs are more than 3, the account will get marked as NPA because the 90 days criteria is getting fulfilled. If it is up to 3, 90 days completion criteria will not get fulfilled and the account needs to be continued under PA category. Another para is there in the master circular, that is para 2.1.3, which gives a little relaxation in these norms. So now the relaxation is restricted to the accounts wherein only interest is due. So these are the typical cases wherein there is a moratorium granted for principal repayment. And in this case, whenever the interest is due and charged in a particular quarter, if it doesn't get serviced fully within next 90 days from the end of that quarter, then the account will get marked as NPA. So when we are talking about March 2021 audit, we need to look at the quarter, which is the last but one quarter, that is October to December quarter. So whatever interest is debited in that account during this October to December quarter, if it doesn't get serviced by next 90 days, that is by 31st March 2021, then only the account will get marked as NPA. So here there is a little relaxation which is given. Not exactly 90 days norms are applicable over here. Now, two exceptions to this rule. First exception is that there might be a term loan wherein moratorium is granted for payment of interest as well as principal portion. So in that case, there is no amount which is due. So since there is no amount which is due in this moratorium period, there cannot be any portion which can be called as overdue. And naturally, the account will remain under standard asset category. Second exception is that typically banks are having staff loans, like staff housing loans, staff retail loans. So in these cases, the terms of repayment are little different as compared to commercial loan. So usually the banks are having a policy, first recover the principal and then they recover the interest. So in that case, the above two guidelines are not really verbatimly applicable. So you need to go by the schedule of repayment of staff loans, and based on schedule of repayment, irrespective of principal or interest portion, if that receivable position is there which is overdue beyond 90 days, then that account will be marked as NPA. So a little deviation will be required for staff loans. Bill purchase, bill discounting facilities. If the bill remains overdue for a discounted period of more than 90 days, then in that case, the account will get marked as NPA. So the normal 90 days norms are applicable over here. In case of agriculture advances, the norms changes. So if your interest or installment remains overdue for a period of 2 crop seasons for short duration crop and for 1 crop season for long duration crop, then the account will be getting marked as NPA. Definition of crop season is, this is a period up to harvesting of the crops raised, and you can get the details of crop seasons through your SLBC committee minutes. So wherever you are doing the audit, you have to refer to the bank which is leading the SLBC, that is state level banking committee, and that SLBC decides about what is the crop season for every crop which is cultivated in that particular state. And based on that, you need to decide whether it is a short duration crop or whether it is a long duration crop. Long duration crop is the one wherein the crop season is more than 12 months, and all others will be designated as short duration crop. Now, as far as agricultural based branches are concerned, typically, many a times you must be hearing whenever you visit the branches that all our loans have been rescheduled, or all our loan repayment have been restructured, and for this current year, it's a moratorium period which has been granted. Now here actually you need to keep one thing in mind, that even though there is a discretion which is granted to the banks to reschedule agriculture advances, it is subject to certain conditions. So the first and foremost condition is that the loan which the bank has restructured under this natural calamity circular, it has to be a farm credit. So you need to refer to the definition of farm credit which is given in the circular dated 23rd April 2015. And you need to first analyze as to whether the account which has been restructured under natural calamity circular, whether it is a agricultural loan or not, because every loan granted to farmer is not a farm credit. Like just to give an example, a tractor loan can be a farm credit, but a loan given to purchase a BMW car to a farmer can never be a farm credit. It's a normal commercial vehicle loan. So that is the first thing which you need to analyze. Secondly, as far as reschedulement benefits are concerned, there are conditions which are set out in the natural calamity relief of natural calamity related circular. So whenever you want to take that benefit, you need to comply with the conditions which are given in the master directions which are related to relief measures. Now friends, just understand one thing. Whenever we are talking about any restructuring norm, whenever we are talking about any conditions which are given, the only relief which is available under restructuring benefits is that to retain the class of assets. So if any of the condition is not fulfilled, reschedulement is possible, but retention of class benefit is not available. So in the next slides also, wherever I talk about any permitted restructuring, it has a limited meaning to say that you can retain the class of asset, because otherwise the restructuring is possible in any case except maybe a fraud account. Now the second thing, or the second condition, is that presuming that you have satisfied yourself that it's a farm credit. Next thing is that one of the 12 natural calamities which are mentioned in 25th March circular must have happened in that particular area. Now, what this March 2015 circular specifies is the regulator has asked the banks to create an institutional framework where there is adequate delegation of power is given at a divisional level or a zonal level. Now, the reason why the delegated powers has to be predefined is whenever a natural calamity happens, the assistance in the form of relief measures should start without loss of time. So that's the institutional framework which RBI expects the banks to have ready with. Then what are the steps which typically a banker will take whenever the natural calamity happens? So firstly, there has to be a declaration of natural calamity. So the declaration is in the domain of sovereign, that is either a central or a state government has to declare something as a natural calamity. And when the declaration of natural calamity happens, the assessed crop loss is required to be at least 33%. And once it is declared and the assessed crop loss is expected to be more than 33%, immediately the meetings are conveyed based on the coverage of natural calamity. So if the calamity is covering the entire state, the SLBC will call up the meeting. If it is covering only few districts in the state, a district level consultative committee meeting will be called up. In restructuring benefit, again, the agricultural loans are divided into two parts, that is short-term loans and long-term loans, and the categorization and restructuring methodologies are different for both the loans. So when you are talking about short-term agricultural loans, there is an eligibility criteria which has been defined and which is a little tricky one. What it says is the loan, whenever you want to take this benefit of restructuring, the loan should not be overdue at the time of occurrence of natural calamity. Now, what I mean by overdue is that even if the account is in default, even for 1 day or 1 rupee also, then that account will not be eligible for this benefit. Now, what is meant by eligibility is that if your account is eligible, then you can get the benefit of retention of class of asset. If the account is not eligible, restructuring is possible, but then there will be a downgrading which will happen. Now, once your account is eligible, you need to verify as to what is the crop loss. So if the crop loss is between 33% and 50%, there is an extension which can be given by 2 years for repayment of loan. And if the crop loss is beyond 50%, the extension can be to the extent of 5 years. Now, these 2 and 5 years will include the moratorium period of at least 1 year. So that is a mandatory moratorium period which bank has to give to as a relief measure to the farmers. And the principal and interest amount due in the year of natural calamity will be converted into term loan accounts. Additional collateral security is not really required to be insisted upon. For long-term agriculture loans, if only crop for that year is damaged and the productive asset is not damaged, then the reschedulement of installment during the year of natural calamity will be given. Extension of loan will be there by 1 year, so that is possible. And the payment of interest can also be postponed. As far as the instances wherein productive assets are damaged, either partially or totally, then the extension of repayment can be given to the extent of 5 years. Apart from that, there are no eligibility criteria or restructuring criteria which are defined. Again, just to give an example, example of productive asset damage or loan for productive asset is concerned. A typical example might be a tractor loan which is given, or maybe a loan which is given for, say, electrical pumps for irrigation purpose. So those will be called as productive assets. So if the productive asset gets damaged, the extension granted is maximum for 5 years. As I stated earlier, the benefit is in the form of not only reschedulement, but also in the form of retention of class of asset. And here actually there is an additional relaxation given that suppose in a particular loan case, if there is a second time restructuring which is happening under the same natural calamity relief circular, then that second time restructuring will not be considered as repeated restructuring, and still retention of class benefit will be made available to that account holder. Whenever a crop insurance proceed is received by the bank, then firstly it will be adjusted against restructured loans, and then whatever balance is left out, that will be adjusted against the fresh loans which are granted to that particular borrower. So it will be kind of a FIFO method which you need to follow whenever the crop insurance proceeds are received. Then as far as derivative transactions are concerned, if it remains overdue for a period of more than 90 days, the account will get marked as NPA. Similarly, for liquidity facilities, if it remains overdue for a period of more than 90 days with respect to securitization transactions, then the account will get marked as NPA. Next one is credit card dues. Now here there is a little relaxation which is given. So here what RBI has been talking about is if the minimum amount payable under the credit card statement, if that minimum amount is not paid within 90 days from next statement date, then the account will get marked as NPA. So here we are not talking about credit card dues in entirety. We are talking about only minimum amount payable. And that too, the counting of 90 days will start from next statement date and not from the current statement date. So there is a kind of realization which is given for these credit card dues. And the last category is working capital finances like CCOD accounts. So if the CCOD account is out of order, then the account will get marked as NPA. Now there are 3 conditions which are set out for out of order status. And if any of the condition is fulfilled, then the account will be required to be marked as NPA. So the first condition is that if the outstanding balance in a particular account, if it remains continuously in excess of the sanctioned limit or DP, whichever is lower for that account, for a period of more than 90 days, then on 91st day, you need to mark that account as NPA. Just to put it in simple words, this is the case of continuously overdrawing of a CCOD account. And friends, here you need to look at the end of the day balances and not intraday balances, because it might happen that in case of a CCOD account, during the day, that is on intraday basis, the account might be within the limit, but that is something which you need to ignore and you have to go by the outstanding balance as on the end of the day. Now here also, let me just add a couple of points over here. Many a times it is argued that the interest which is debited in a particular account on say month end, which relates to the monthly interest portion, sometimes people keep on arguing that that particular portion of interest is due on the next day. But there is nothing like that actually. The moment interest gets debited in the account, it becomes part and parcel of that account and it is due immediately on the same day. So the interest which is debited in the account on 31st March 2021 is due on 31st March 2021 itself. So you need to count the balance which is post-interest balance and not pre-interest balance. So I just thought that I will just add this particular point when we are discussing about this out of order status itself. Second condition is that if you have an account which otherwise might be a normal account, so irrespective of the balance outstanding, if there are no credits in the account for a continuous period of 90 days as on the date of balance sheet, then the account will be called as out of order status account. So when you are looking at the 31st March 2021 balance sheet, if there are no credits in the period of 1st January till 31st March, then the account will get marked as NPA. And the third one is that if the credits in the account are not sufficient to cover the interest debited in the same period, the account will get marked as NPA. Just to correlate that with 31st March 2021 audit, compare the last quarter, and in comparison, you have to compare the credit summation during 1st January 2021 till 31st March 2021. So if your interest debited in that period is less than credit summation in that account, then the account will be getting marked as PA. Let me give you an example. Let's presume that the monthly interest in that account is at 10,000 rupees. So in all, we have 3 months interest at 30,000 rupees. That is January, February, March interest. So if you have credit summation beyond 30,000 during the same period, that is 1st January till 31st March, then your account will be marked as PA. If it is less than 30,000, the account will be considered to be an out of order account and you have to mark that account as NPA. Now here, friends, you need to keep one thing in mind. Here the concept is of comparison of credit summation with interest debited and not really an interest servicing concept. See, nowhere in NPA norms, interest servicing concept is there. Everywhere the concept is of overdue, or in these last 2 instances, not having an account operation. No, that is a concept. Servicing of interest concept comes up only when you mark that account as NPA. So the moment you mark an account as NPA, then you have to verify that what is the unserviced portion is there. And then based on that, you have to make a provision equivalent to that unserviced interest, or you have to reverse that unserviced interest as on that NPA date. Now, what is the definition of overdue? Just for clarity purpose, I have just quoted it. If an amount due to the bank under any credit facility, if it is not paid on the due date which is fixed by the bank, then that portion will be called as overdue. Just to give a live example of that, let's take a case that you are having a housing loan and the housing loan borrower has prepaid the all 12 months installment in the month of April itself. So when you look at the account, you will have all 12 months installments may be received on say 10th April for that particular month. And subsequently, till March end, that particular borrower hasn't paid a single installment. Now, this account, if you look at the ledger account of this particular case, the account will look like you have a credit of 12 installment on say 10th of April, and subsequently there are 12 interest entries which will appear in that term loan account. But the account will be still required to be treated as standard account because there is no amount which is overdue. He has already paid you all the installments. So the interest servicing, even if it is not done, it really doesn't matter because there is nothing overdue. And that's why this definition of overdue is really important. As I stated earlier in my first slide, whenever you say that an account is overdue, you have to compare the ideal DP with the ledger account balance. If your ledger account balance is more than ideal drawing power, then only the account will be treated as overdue. And then you have to think about whether the account is NPA or not, based on whether it is overdue for 90 days or not. So this was basic about IRAC norms. Let me just look at the queries which are there. I think all queries are related to PPTs. The branch will be distributing this PPT to all of you. So don't worry about that. Everything will be made available to you. Coming back to PPT, if there are any accounts with temporary deficiencies, RBI has defined how to deal with that. Typically, if you look at this paragraph, the first two lines are, you can say, a little favoring to the auditee, in the sense these two lines are always been favored with the bankers, because the first two lines says that one should not mark an account as NPA merely on the basis of some temporary aberrations in the account, like say non-submission of stock statement, not having adequate DP, non-renewal of accounts. But at the same time, the closing two paragraphs of this particular paragraphs in the IRAC norm specify as to what is meant by temporary deficiency and how to deal with that. So let's start with the first one. First one is about non-submission of stock statement. Now RBI has specified that in case of large borrower accounts, there is a leverage which is given to them, because typically it takes time for large borrower accounts to compile the data for stock statement. So in that case, RBI has stated that whenever a stock statement is submitted by a large borrower account, you can use that particular stock statement to draw inference of drawing power from that for next 3 months. So suppose you have September stock statement submitted to the bank, then that September stock statement based DP can be used for next 3 months. That is for October, November, and December. And after that, you cannot use that stock statement for DP calculation purpose. So after that, when 90 days gets over, you have to mark that account as NPA. Now, friends, this condition is not a generic, relaxation which RBI has given. They are only referring to large borrower accounts over here. So for a normal account, maybe say an account with having a 50 lakh outstanding balance, you cannot draw this inference out of this circular. So there actually what you need to determine is the DP will get used only for next 1 month. So September stock statement DP should be used only for October month. After that, once you finish off 90 days, you need to mark that account as NPA. So it's not a blanket permission of 180 days which RBI has given. So just to put it in simple words, for a large borrower account, if last 6 months stock statements are not submitted, you have to mark that account as NPA. For other than large borrower account, if the stock statement is not submitted for last 4 months, you have to mark that account as NPA. Next instance is of non-renewal of accounts. So whenever an account is not renewed regularly, you need to mark that account as NPA after completion of 180 days from the due date. So suppose you have a case wherein the due date of renewal is say 30th September. And till March, you observe that, till 31st March, you observe that the account is not renewed. So in that case, 180 days are completed and you have to mark that account as NPA. Many times the bank might do a short review or a technical review for say 90 days, and maybe it can be done twice also, thrice also, depending upon the bank's policy. So when you're counting 180 days, you need to count those 180 days from original due date and not from expiry of short review period. Short review is only a stopgap arrangement for operational purpose, which is done by the bank. So short review typically takes place whenever there is a non-submission of document happens from the borrower side. So it's a stopgap arrangement. So that has nothing to do with 180 days norms. 180 days counting should be from original due date itself. Second point is about non-regulation of ad hoc limits or TODs. So suppose a bank has sanctioned a TOD or ad hoc limit to a particular borrower account, and if it is not regularized within 180 days, then the account will be marked as NPA. So here at times you might face a situation wherein this ad hoc or TODs get converted into a regular limit. So in that case, you need to test that account as to whether it is in the nature of accommodation or whether genuinely the business volume of that particular borrower account has increased. So there is a need for additional drawing power, or there is a need for additional limit which is perceived by that account holder. So there will be always a thin line to decide between accommodation and a regular enhanced limit sanctioning which takes place from the bank side. But as an auditor, you need to professionally look at that and derive at the conclusion. Then we have some exceptions to this rule which RBI has given to normal IRAC norms. So the first one is if an advance is sanctioned against underlying deposit, underlying security of term deposit receipts or NSCs, IVPs, KVPs or surrender value of life insurance policies, then that account should not be treated as NPA till security cover is sufficiently covering your outstanding balance. So till your balance is within the security cover, your account will be PA, irrespective of whether it is overdue for more than 90 days, whether it is overdrawn or not. And otherwise, the account will be always treated as PA. If it crosses the security cover, then the normal IRAC norms will be applicable. As far as income recognition is concerned, whenever the interest is debited in such accounts, you need to verify whether the margin is available or not. So because of debit of interest in the account, if the outstanding balance is going beyond security cover, then that interest should be recognized on cash basis and the account should not be debited with that interest portion. As far as gold loans are concerned or any other loan against any other government security is concerned, there is no exemption which is available. Similarly, for state government guaranteed accounts, there is no exemption which is available from IRAC norms. But as far as central government guaranteed accounts are concerned, if the central government guarantee is live and enforceable, then in that case, even though the 90 days delinquency is observed in that particular account, the account should not be marked as NPA, but then the account is required to have income recognition followed on a realization basis criteria. So on one hand, your account will remain under PA category if it is backed by central government guarantee, but interest recognition or income recognition has to be there on cash basis. Another clarification which RBI has given is the clarification has to be done on a borrower basis. That is, borrower-wise classification norms are required to be adopted. And when you adopt that norm, it means that whenever one facility of a borrower has been marked as NPA, rest all facilities will be marked with NPA categorization. So it will be based on customer ID consent. Two exceptions to this rule. One exception is that if you have a LCBD exposure, then that exposure is supposed to be not on the borrower, but on that LC issuing bank. So LCBD will remain into standard asset category, provided that it is not overdue, even though the other exposures with the borrower might be under NPA categorization. Second exception to rule is that suppose you have a credit facility which is sanctioned to PACS and FSS for onward lending arrangements, then in that case, that onward lending arrangements are required to be analyzed. And out of that onward lending, maybe a couple of loans might have turned into NPA category. So only to that extent, you have to carve out the portion of total credit facility sanctioned to PACS and FSS. That portion will get marked as NPA and the balance portion will remain under standard asset category. So these are two exceptions to borrower-wise classification norms. As far as consortium advances are concerned, each member bank is required to classify an account based on their own record of recovery. So suppose you have a case where it's say 3 consortium member banks are there. It might happen that in 2 banks, the account might be under NPA category, but for one bank, that 90 days norms are yet to be fulfilled. So the account can remain into standard asset category. Now here, as an auditor, you need to be little careful about one thing. You need to test that account as to whether the account is showing any signs of inherent weakness or not. So if you see that there is an inherent weakness, signs are visible in that account, there is a sustainability issue in that account, then in that case, you don't have to wait for 90 days norms and you can simply mark that account as NPA. Of course, this this inherent risk criteria is not only for consortium advances, but it applies to all the advances. We'll talk about that a little later also. Let me just look at the queries. Relaxation of temporary deficiency in regard to large borrower accounts only. Definition of large borrower account. So large borrower account is not defined by RBI. So typically every bank has a definition of large borrower done for their in their credit policies. You need to go by that. And in fact, the bank has to demonstrate before you that how they are determining between large borrower and other than large borrower. For example, as an auditor, if you just want to take a rational stand, you can go by LFR basis, which has come in new LFR about 10 crores and other norms. So that can be one criteria which you can follow. but the onus of proving that whether a particular borrower is large or other than large lies with the auditee bank. They have to demonstrate before you. But RBI per se hasn't given any definition as to what is meant by large borrower account. Frankly speaking, just to put it on you can say a more acceptable form, you can have just 5 crores or 10 crores set as a benchmark for you as a take a professional judgment, and you can go by that and take that under MRL. But again, just to repeat, just have it checked up with that particular bank. Then we have two instances wherein straightaway classification norms have been defined by RBI. Now, these particular cases, when I'm talking of straightaway classification, these are the instances wherein RBI expects that the account should be marked as NPA, irrespective of completion of 90 days norms. So let's start with the first one, which we discussed earlier also, that erosion in value. So where the realizable value of a security is less than 50% as compared to the last value assessed by the bank, then that account should be taken straight away to doubtful asset category. So the example I will just repeat. You are having a case wherein there is a property advance which has been sanctioned. Last valuation report is of 10 crores. Current valuation report is of 4.5 crores. So in that case, since there is a erosion beyond 50%, in that case, you have to mark that account under doubtful asset category. So you don't have to wait for the account to become a substandard account. Second instance is that where the realizable value of the security is less than 10% of the outstanding balance, that is outstanding ledger balance, then the account has to be taken straight away to loss asset category, again without waiting for 90 days norms to get fulfilled. Now here actually in both the cases, you need to keep one thing in mind, that the account should be a secured loan. Now what is the definition of secured loan? Secured loans are those loans when at the time of sanction of the loan, you have an underlying security which is not less than 10% of the loan amount which is sanctioned, and the loan amount sanctioned will include fund-based and as well as non-fund-based limits. So the categorization of the account between secured and unsecured will be right from the initial stage, that whenever the loan gets sanctioned, the categorization happens at that level. So if it is secured loan, these two conditions are required to be also applied for that asset classification. As far as fraud related accounts are concerned, you have to make a provision of 100% irrespective of the underlying security. In the sense, even if the underlying security might be in the form of bank FDs itself, still you have to make a provision to the extent of 100%. Only one relaxation which RBI has given is, if the bank has reported a fraud under the FMR reporting framework, then in that case, you can stagger that 100% provision in next 4 quarters. So that is only, you can say, a little relaxation of staggering of provision which RBI has given. And if it is not reported to Reserve Bank, then you have to make 100% provision instantly. That is in the same quarter when the fraud is getting detected. Now we'll come to the last part about NPA categorization, and which is the most crucial and important part. And this is where there is a little kind of subjectivity which is involved. In all other earlier criteria which we discussed about, there was no subjectivity which was really involved over there. So here the subjectivity is about how to decide about what is the inherent weakness in a particular account. But before that, let me just give you a couple of examples. See, all of us have seen that in many accounts, there are certain solitary or few credit entries which get recorded in the account just before the balance sheet date. And using those credit entries, the accounts get regularized. So here actually, as an auditor, you need to verify that what is the source of funding of these credit entries. And if the source of funds for these credit entries is related to business receipts, you can say that the account is regularized in a normal form. But if the source of funds are not related to business receipts, you have to simply ignore that regularization, and you have to verify that whether the account is having an inherent weakness or not. And based on that, you have to mark that account as PA or NP. So let me just give you a couple of examples about genuine credit entries and credit entries which are not related to business receipts. So giving example of genuine business receipt, the simplest example is that suppose you are having a government contractor account, and in the government contractor account, you receive the receipts of long outstanding receivables from government agencies, which is a typical habit of government agencies to release the funds only at the year end. So in that case, the account can be said to be regularized out of genuine business receipt. Another example is that suppose you are having a long outstanding book debts, and that long outstanding book debts are realized today. So in that case, It's again a genuine business receipt. Now let me talk about the receipts, that is the credit entries, which are not really in the nature of business receipts. Simplest example is that it might be an evergreening case wherein the bank sanctions additional credit facilities to the borrower account, and using that proceeds of those additional credit facilities, the account gets regularized. It's a clear-cut case of evergreening, and you have to mark that account as NPA. Another example is that maybe partners or directors in the entity, they might infuse certain funds, maybe by taking loans or maybe out of their own source of finance. So in both these cases, when they introduce certain funds, maybe in the form of capital or in the form of loans, unsecured loans given to that entity, this can never be called as a business receipt as such. It's a kind of a loan or funding or investment which is done. So if that happens, actually, it doesn't prove your income generation capacity of the bank. And if there is no sufficiency of income generation, you can call that account to have an inherent weakness, and you have to mark that account as NPA. So whenever you are sure about an account having an inherent weakness, you have to simply mark that account as NPA. Otherwise, you have to ask the bank to demonstrate before you as to how the account is regularized, and if the bank is able to satisfy you in terms of source of funds which are coming out of genuine business receipts, you can always call it as a PA account. As far as mandatory valuation of securities are concerned, the mandatory norm is applicable only to certain class of asset. So wherever you are having an account or a customer marked as NPA, and if the exposure to that customer is more than 5 crores, then the mandatory valuation conditions are applicable in forms. One is that there has to be an annual stock audit conducted by external agencies. Second one is that the immovable properties, when they are offered as a security with respect to such account, then in that case, the valuation has to be carried out once in 3 years by the approved valuer on the panel of the bank. In case if it is a PA account, irrespective of the balance outstanding, there is no mandatory valuation norm as per RBI circular. And wherever you are having an NPA account which is having exposure below 5 crores, again mandatory valuation norms are not applicable. So there the bank policy will prevail. So here you have to be careful about putting the comment in LFR as to how you put that comment. Now, one more thing is that suppose you come across a case wherein that immovable property is not valued in last 3 years, and you are having exposure above NPA exposure above 5 crores for that borrower account. So in that case, you have full discretion with you to even ignore the last valuation report, and you can say that you can consider that value as zero, because there might be a possibility of deterioration in the value also. Maybe because of encroachment, or maybe the property might be now in depleted condition. There might be various reasons which are possible to reduce the realizability of that immovable property. So in that case, you can use your discretion. Another point is that suppose you are having say consumer durable loans or maybe a vehicle loan, you need to make it a point to ensure that there is a criteria which is followed by the bank to reduce the realizable value of such security. You cannot have a security value which can be continued equivalent to a invoice value. Like, all of us have seen that many a times at the time of filling up of the master data, the vehicle loan with respect to especially vehicle loan, the value which is paid is the invoice value at the time of purchase of that vehicle. And maybe if the account turns into NPA after 4 years, the same value is considered as a secured portion. Now that is something which is wrong. So you need to reduce that value based on your professional judgment, or you have to ask the bank as to how they are reducing the value on a systematic basis. Let me just take up the query before I ask you 2 questions. If a gold loan is regularized at a year end and restructured, can we mark it as NPA? See, whenever any account is restructured, now you are given an instance wherein firstly the gold loan is regularized. So now the account is not having a overdue status. After that, it is restructured. So if it is restructured, unless there is a retention of class benefit is available for that account, then only the account can retain the class. But otherwise, in normal circumstances, if a gold loan, whether it is regularized or not, if it is restructured, then it has to be downgraded to substandard asset category. So if the loan is getting covered under COVID-19 circulars, which we will be talking about in subsequent slide, then only it can retain the class of asset. But in normal case, it is required to be downgraded. Let me add one more point over here. Since you asked the query about gold loan, that suppose you have a gold loan and instead of repayment of gold loan, there is a new gold loan which gets sanctioned, and using the new gold loan proceeds, the earlier gold loan gets closed. So it's a clear-cut case of evergreening which is visible, and you can mark that account as NPA. The reason being the gold loan is not repaid back, but it is repaid out of proceeds of the new loan which is sanctioned to that borrower. So in that case, even if the security is different, you have to still mark that account as NPA because the proceeds of new loan has been to close the earlier loan. Now, two quick questions for all of you, and you can answer that in chat box window. So let me just convert the first case into I will attach few dates to that. Let's presume that we are having a term loan account, which is having 4 installments overdue on say 15 December. And after 15 December, 2 installments out of 4 have been recovered by the bank. But the balance 2 overdue installments are not really recovered. And as on March end also, we have a status wherein 2 installments are still overdue. So will you mark this account as NPA or you will say that this account is PA? So just to repeat, we have 15 December when 4 installments are overdue. And from 16 December onwards, we have a case wherein the minimum overdue portion is 2 installment, but the account is not regularized. So it's a partial recovery case. So will you say that this account is PA or you will say that it is NPA? So you can just post your views in the chat box window. Okay, one person has said PA account. Any other views? Okay, I will just give the logic why that account should be still NPA. See, whenever any NPA condition is fulfilled, that account has to be marked as NPA. So on 15 December, the account was having 4 installments overdue. So naturally, it was overdue for more than 90 days. So the account will get marked as NPA on 15 December. Subsequently, if you want to mark that account as PA, there has to be a complete regularization which should happen. So the partial recoveries will not help. The account needs to have a status wherein it's a 0 overdue position on a particular date. And whenever you reach a 0 overdue position, then only you can mark that account as NPA. In this particular case, the account will be continued to be under NPA category until the time the account is having 0 overdue status. Now let me come to the second question. Okay, does the condition only apply to NPA to PA? Yeah, this condition will apply to NPA to PA. So whenever your account is NPA, if you want to regularize it, you need to have a 0 overdue status, and then only the account will get converted into a performing asset category. Let's talk about the second condition, which is a more interesting one. That on 31st March 2021, the account is having 4 installments which are overdue in a term loan account. So it's a clear-cut case of NPA account on 31st March 2021. You are signing the balance sheet on say 10th April 2021, and the account is regularized on say 5th April 2021. In the sense, it's a 0 overdue position on 5th April. Or let's take an extreme case that the account is closed on 5th April 2021. So will you say that this account is PA or you will say that this account is NPA? You can post your views in chat box window. Okay, so all of you are agreeing that the account is NPA. So I think I don't have to explain more. Just to repeat, actually, see, whenever you are receiving anything in any account which is subsequent to your balance sheet date, then in that case, you have to simply ignore that because it is not an event occurring after the date of balance sheet. The definition of event occurring after the date of balance sheet is entirely different, and whatever amount you are receiving in a particular account, that is not really an event occurring after the date of balance sheet. It's a normal thing which happens in any banking business that you keep on recovering an account from various borrowers related to that bank. So these are just 2 reference paras to stress upon my point. That is para 4.2.5 and para 4.2.2. So these are just 2 quick reference paras for you to analyze the condition which we discussed earlier. Now we'll come to the point about relief granted to MSME borrowers, and keep one thing in mind, that it's a one-time relief. So if any borrower account has availed a relief, that is one-time relief under any of these MSME circulars, then he cannot avail the similar relief in subsequent circulars. So it's only one time during the lifetime of that particular borrower account. So the first circular which got issued was 7th February 2018 circular, and it was supplemented by 6th June 2018 circular. Then that circular or the scheme under this circular got extended by 1st January 2019 circular. Again, the scheme got extended by February 20 circular, and again it has got extended by August 2020 circular. Now, when I say extended circular, there are two dates which get extended. One is the cutoff date, which determine the eligibility for that particular account. And the second date is date by which the scheme is required to be implemented. So the last circular, 6th August circular, talks about reference date of 1st March 2020, which talks about eligibility criteria. And it talks about the second date, that is 31st March 2021. So this is the cutoff date by which that particular account or the bank has to implement that particular relief measure. So in next slides, we'll talk about this 6th August 2020 circulars. And this circular is in continuation of 11th February 2020 circular. So all other conditions have remained same. So the first thing is that, again to repeat, it's a one-time relaxation given to MSME borrowers. So for MSME borrowers who have availed that earlier, they are not eligible to avail it again under the subsequent circulars which are issued. The first eligibility criteria is that the aggregate exposure of banks and NBFCs to that particular borrower, which will include fund-based as well as non-fund-based exposure, that should be within the cap of 25 crores, and the cap will be considered as on 1st March 2020. So on 1st March 2020, if the exposure is up to 25 crores, you can avail this benefit. So here, friends, RBI has been referring to exposure and not balance outstanding. So it might happen that you have an account wherein the limit is not utilized, but still you have to go by the limit. So typically in case of BGs and LCs, it's a very common scenario that you have BGLC limits which are sanctioned, but which may not be really utilized on a continuous basis. So in that case, you need to keep this in mind, that it is not balance outstanding, but it is exposure to that particular borrower. Second condition is that the borrower should be in standard asset category as on 1st March 2020. So that is the second condition which is there. So if any account is NPA as on 1st March 2020, even if it gets upgraded subsequently, still it is not considered as eligible for this particular scheme. And any account which might be a standard account on 1st March, you need to test that it is within 25 crores criteria. Third condition is that the borrower has to be registered under GST, except one case, that wherein the GST threshold limit of turnover is not met by that particular borrower. So naturally, he is exempted from that. But if a borrower is not GST registered as on that particular date, then he can opt for GST registration, and he has to ensure that GST registration procedure gets completed before the implementation happens. And restructuring of borrower accounts under this scheme has to be implemented on or before 31st March 2021. So that is the cutoff date by which the bank has to complete the implementation of this process. Other than this, there is no other eligibility criteria is there. And how to restructure also is not defined. So as an auditor, you need to just verify as to what is the criteria which the bank has adopted as far as how to restructure a particular account. But frankly speaking, theoretically, if you ask me, even if someone restructure that for say 25 years or 30 years also, it is very much permitted. Only thing is that bank has to establish the viability of restructure. What is the benefit which is additionally given is, in para 5 of this circular, there is additional benefit which is given. Like suppose our account was PA as on 1st March, but before date of implementation, let's presume that the account slips into NPA category. Then there is a benefit which is given that after implementation, that category can be rolled back to standard asset category. So it's additional leverage which RBI has given. So an account which falls between say 2nd March till say 30th March under an NPA category, but on 31st March, the implementation of this relief is already undertaken by the borrower and the bank, then the account will be rolled back to standard asset category. There is additional provision requirement of 5% which is required to be made, and it has to be retained till the end of specified period. specified period is the one wherein the account has to show demonstrate a satisfactory performance, wherein the period of 1 year is marked. That 1 year counting will start from the date when first interest or installment under reschedulement is due. So from that, within that 1 year period, there should not be any overdue position beyond 30 days. So if it happens, then it will not be called as demonstrating a satisfactory performance. The accounts which are restructured earlier under MSME schemes are naturally not eligible. Post restructuring, normal NPA norms are applicable. Disclosure is required to give disclosure of number of accounts and the amount of loans which are restructured. And if the restructured account is downgraded to NPA accounts further, based on normal IRAC norms, the upgradation will be on a similar, ground. Whenever the recovery of entire overdues is done, it can again go back to standard asset category. So we'll come to COVID-19 related circulars, one after the another. First two circulars, all of you must be familiar with if you have done the last year audit. That is 27 March circular and 17th April circular. But I'm just repeating those circulars. The reason being, all these circulars are linked with each other. So we'll start with the first circular and we'll come to the last circular of 6th August 2020. So this circular which got issued on 27 March 2020, the purpose was to mitigate the burden of debt servicing to the borrower accounts which are hit by disruption on account of COVID-19 pandemic. And RBI wanted to have a continuity of viable businesses. So it brought out some relief measures. The relief measures were in three forms. One was reschedulement of payment of term loan and working capital facilities. Second one was to ease out working capital financing. Third one was relaxation from classification of SMA and non-performing asset criteria. Let's start with the first one about the reschedulement of payment which is permitted. Now, when I'm saying permitted, it means that if you are fulfilling the conditions which are given in the relief measure, you can retain the class of asset. So reschedulement or benefit given is limited to that extent. If anyone crosses those criteria, the account is required to be still downgraded. Let's start with the first one. Now here actually term loan RBI has specified that term loan will include EMI based repayment loans, interest or principal repayment loan, bullet payment loans and credit card dues. Everything is included other than working capital finances. What is the relief? Relief is given in the form of permission to grant a moratorium period for 3 months with respect to all payments of all types of installments for all types of loans, all types of term loans, which are falling due between 1st March till 31st May. Now here actually, whenever a moratorium is granted, what RBI specified is, to the extent of the moratorium period, the residual tenure of the account will also get extended. So if one avails a moratorium period of 3 months, the residual tenure of the loan will also get extended by 3 months. So now this is a condition. So if you have a moratorium period of 3 months, you cannot extend residual tenure beyond 3 months. So what will happen is, the interest component between 1st March and 31st May, that interest component will get loaded to subsequent EMIs. So the EMI has to undergo a change. If the EMI is not changed, naturally the residual tenure will increase beyond 3 months. So in that case, the account is required to be downgraded because RBI is restricting how much extension for residual tenure is given. So as far as granting of moratorium period is concerned, there are two types of practices which are followed in banking sector, and both are vetted by RBI in their various policy statements. First practice is that few banks have given an option to the borrower to apply for this moratorium period. So here actually the initiation will be from the borrower side, that they will approach the bank and they will apply for moratorium period, and the bank will naturally sanction that moratorium period. Second one is that there are some banks which have granted moratorium period to all the borrower accounts with a window kept open for borrower accounts not to opt for moratorium period. So it's exactly opposite way to deal with this situation. Both these criteria or scenarios have been vetted by RBI. So what you need to do is, you need to first ask your bank that what was your approach towards granting moratorium period, and whatever is the approach of the bank, you have to see that whether the board has approved this approach or not. And based on that, you have to ask for the demonstration from the bank side as to how that criteria was adopted. Like for example, if the bank says that we have granted moratorium period to all the loan account holders, so in that case, you have to ask the bank to demonstrate before you as to whether the option for opting out of that moratorium period was made available to the borrower accounts or not. If not, you have to comment on that in LFR also. Second point is that whenever you're talking about this moratorium period and extension, whenever an account holder opts out of that, in the sense, suppose I'm a borrower and I don't want to, have that moratorium period benefit granted to me, I can always approach the bank and say that I don't want moratorium. Then in that case, normal IRAC norms will be applicable in these particular cases. Now take a classic case that you have a scenario wherein an account is NPA on 29 February 2020. Still moratorium benefit will be available. So what might happen is a NPA account might go for moratorium period, and whatever earlier overdue portions are there, that can be nullified during this moratorium period, and the account can be upgraded also in this particular scenario. So this moratorium period availability, the benefit availability is across all the account holders. So it's not only for PA accounts, but it is also for NPA accounts. As far as working capital facilities are concerned, which will exclude LCBD facilities, the relief was given in the form of deferment of recovery of interest, which is applied during the period of 1st March till 31st May. So whatever interest is debited in the account during this 3 months period, the payment of that is deferred till 31st March 2020. Now this is something wherein borrower don't have to really approach the bank to get this benefit. It's automatically given to all the account holders, wherein the amount will be considered as due only at the end of deferment period of 31st May. So it is kind of automatically granted benefit. And naturally, this will change your out of order status also, because the interest will no more be considered as due. So when you're talking about comparing credit summation with interest portion, this portion will get postponed to 31st May. So on 31st May, entire 3 months, interest portion will be considered as due. There is a one query. Let me address that query. The maximum moratorium can be only of 3 months or extension of. See, as far as moratorium is concerned, under this scheme, it was only for 3 months, and extension of tenure is only for 3 months. Of course, this is extended further by additional 3 months, but we are on this circular, so I'm sticking to 3 months criteria. So the extension of tenure is also for 3 months. You cannot go beyond 3 months. Will the bank show the amounts as income and not due, that is accrued income? No. See, as far as the interest portion is concerned, it is accrued and due. Only thing is that for payment, there is a deferment which is granted. So the bank will capitalize that interest. It's accrued and due also in stricter, going by accounting concept. For ease of understanding, I'm saying that it is accrued but not due, but it's only a deferment as such. So the payment cycle has been changed. So till that time, your interest portion will not be counted for comparing that with your DP. So just to give an example, suppose you are having 100 rupees as your normal ledger balance. 2 rupees is the interest related to that particular period. So when you are comparing overdue status or overdrawn status, you have to compare 100 rupees and not 102 rupees. So interest will get excluded whenever you are counting that overdue or overdrawn status. So that is the only limited benefit which is available by way of deferment. Now, as far as relaxation of margin concept is concerned, the relaxation was given in 2 forms. One form was in the form of reduction in the margin. So let's take a case that a normal margin for say book debts is 40% and stock is at 25%. So the bankers were given a discretion to reduce that also, maybe to say 15% or 10%, but that percentage will get defined by the bank. Second relaxation was given in the form of reassessment of working capital cycles. So just to put it in again in simple words, maybe earlier the banks were permitting a book debt up to 90 days for calculation of DP. So that might be relaxed to say 120 days or 150 days, depending again upon the bank's discretion, which the bank is reassessing the working capital cycle. So these 2 relaxations were given. One was relaxation in margin and one was relaxation in calculation of working capital assessment. Now, as far as the NPA norm relaxation is concerned, there was no relaxation which was given by way of this circular. So the circular was silent as far as this aspect was concerned, and the real relaxation was given by way of 17th April 2020 circular. Now, just before we go to 17th April circular, practically this circular was applicable to borrower accounts which are affected by COVID-19. So there has to be something on the record, at least in the form of borrower's application or some signs which bank has to demonstrate before you that the borrower was affected by COVID-19 pandemic scenario. And as far as banks' policies are concerned, there is a complete discretionary powers which RBI has granted to the banks to deal with this scenario. So RBI has been very liberal about relaxation of margins, relaxation in reassessment of working capital, working capital cycles for the borrower accounts. Now, as far as EMI is concerned, EMI is naturally expected to undergo a change to verify as to how the bank is dealing with that, because it will require a lot of changes. Like, you have to change ECS instructions which are given, standing instructions which are given. Possibly, you need to also update the documentation or master data accordingly. You need to have your CBS system also equipped to give this effect. So, as an auditor, you need to be vigilant about these points. Now, let's come to 17th April circular. 17th April circular was issued with a purpose that RBI wanted to give a relaxation in asset classification norms. To put it in simple words, it was more of a status quo benefit which RBI wanted to grant to the borrower accounts, and it was in continuation of global commitment to Basel Committee norms, wherein RBI is also a participant. And the relief was again subject to certain conditions. So firstly, let's talk about the relief. Then we'll come to the point about how much provisioning is also required to be made. Now, relief was granted in only one form. It is nothing but a status quo clause. Now, firstly, there is an eligibility criteria to avail this relief. So eligibility criteria is that the term loan account should be a standard account on 29 February 2020, and that account should have availed benefit of moratorium period. So if the moratorium period is not availed, then this relief is not available. And what is the relief which is made available? The relief is from counting the 90 days delinquency. Now, when you are counting 90 days delinquency, you have to exclude the period of 1st March till 31st May. So suppose particular account, 70 days overdue portion of 70 days overdue period is completed by 29 February. Then next 20 days period counting will be done after completion of this 3 months period. So from 1st of June, you have to count that balance 20 days. So that was a benefit which is given to exclude the period from counting of delinquency norms. Few other points actually. This particular benefit is not available for accounts which have not opted for moratorium period. So their normal IRAC norms are applicable. Second thing is that upgradation of the account is very much permissible. So when we say status quo, it doesn't mean that you cannot upgrade. So any account which is NP on 29 February, if they repay that overdue portion, if they remove the delinquency, the account can very well be upgraded to standard asset category. So that was permitted. As far as working capital finance facilities are concerned, similar logic was extended, that account has to be a standard account on 29 February. And when you are counting out of order status, when you're counting this 90 days period in that out of order status, you have to exclude the period between 1st March till 31st May. Again, you can have upgradation of working capital facilities possible during this intervening period. Now, RBI made a specific mention of provisioning requirement to certain accounts which otherwise would have turned into NPA. So suppose you have availed this benefit of status quo, but if this status quo benefit was not available, then your account would have been otherwise classified as NPA. Then in that case, RBI has stipulated that you have to make a 10% provision on your account, and the provision will be staggered. That is, half provision has to be made by March 20 and half has to be made by June quarter end. Now, this provision has to be made account-wise and not borrower-wise. So it's an interesting thing that it might happen that in case of a borrower account, you have multiple facilities, but the NPA status might have been made only in few of these accounts. So you have to make that provision only restricted to those accounts and not borrower-wise. Now, what is the provision? So I will just give you an example. Let's suppose you have a case wherein term loan account installment is overdue since 15 December 2019. So 15 December 2019 overdue status will not make that account NPA on 29 February 2020 because only 75 days are completed. So that account should have been marked as NPA on say 15 March 2020, presuming that the installment is still overdue. So there 50% you will make it in March and 50%, that is 5%, you will make it in June. So in short, it talks about accounts which otherwise would have turned into NPA, and accordingly you have to make a provision of 10%. This provision utilization is also defined by RBI. So suppose such account is subsequently slipping into BDTR category, NPA category, you can make use of this provision for that BDDR provision. Or if any other account slips into NPA category, you can again use this standard asset provision, which is a prudential provision, to make use for other BDDR accounts wherein the NPA slippages are there. Some other considerations which you need to keep in mind: there is no bar on upgradation of the account, so the account might keep on upgrading. Another point is that wherever the NPA accounts are there, which are NPA on 29th February, the aging continues to apply. So suppose you have a case wherein the date of NPA was say 15th March 2019. So in that case, on 15th March 2020, the account has to be converted into a doubtful asset category. So that aging continues to apply. And the circular also provides about disclosure in notes on accounts for 1920-2021 financial year. It talks about more about what is the benefit which is granted and which are the accounts wherein this 10% provision has been made. Which are the account in the sense I'm talking about quantum and not account per se. As far as documentation requirements are concerned, most of the banks are not really having any documentation requirement for such accounts which are having the benefits under this policy. The reason being, wherever you have a regulatory benefit which is granted to account holders, you may not be really requiring additional documentation. But my suggestion is that just have this double check with the banker where you are doing the audit, and if possible, have the bank circular taken on the record which specifies that additional document requirement is not there. Or maybe they might be having a single page form, or maybe it might be in the form of emails received or SMS consent received. So verify the form as to how this scheme has been implemented. Second important factor is that just test the CBS system as to how CBS system has adopted this kind of a regulatory package. It's not that easy for a CBS to adopt all these criteria, especially about deferment of interest criteria. Now there is second circular which was issued on 17th April 2020, which was related to June 2019 circular, wherein the resolution framework is defined. So there what RBI stated is the review period of 30 days, which is there in paragraph 11. So when you're counting that review period of 30 days, then in that case, the period between 1st March till 31st May will be excluded. Similarly, the 180 days period which is mentioned over in paragraph 11, same logic will continue to apply, wherein you need to exclude the period between 1st March to 31st May. As far as next circular is concerned, that is circular dated 23rd May 2020 is concerned, it is more of extending the benefit granted by earlier two circular, that is 27 March and 17th April circular. So the earlier 3 months criteria which we are talking about for 1st March till 31st May period, that period is further extended by 3 months. So now we have a period from 1st March till 31st August, 6 months period. So a term loan account holder can avail this benefit and you can extend the tenure by next 6 months. So if something is beyond 6 months, retention of class of that asset class, that is standard asset, is not available. Similarly, for working capital finance, the interest which is debited in the account between 1st March till 31st August, the repayment of that is deferred till 31st August 2020. Now, friends, over here, there is one more line which is added by RBI, which is not directly related to this deferment. So first part is that deferment of interest payment is permitted till 31st August. So suppose you are having 10,000 rupees monthly interest which is getting debited in a CCOD account. That 6 months interest, which is amounting to say 60,000 rupees, the borrower can pay that interest by 31st August 2020. So after 31st August 2020, that interest will be considered as overdue. Now here, there is one more option which is made available by RBI. Now friends, listen carefully because it is an option and it is not a tag along to that deferment. So it's not a deferment extension. Option is to convert that accumulated interest portion, that is a deferred portion, into a funded interest term loan. So it's not that the deferred portion will always get converted into FITL. It is at the option of the borrower that the bank might convert that into FITL. So there will be a sanction process which the bank has to follow. The moment it gets converted into FITL, it's a new credit facility which is sanctioned to that borrower. And as you are all are aware, there is an accounting treatment which is specified with FITL accounts in IRAC circular. So keep your accounting concepts very clear that whenever a loan facility is sanctioned against the interest which is due, then naturally it has to be provided with 100% provision. And as and when FITL will get repaid back, To that extent, the income is permitted to be recognized in P&L account. Second point is that this FITL facility, there is a condition which RBI has put in, that FITL has to be repaid by 31st March 2021. So depending upon the sanction criteria, you have to test that for NPA criteria. So suppose a bank is having a very liberal policy, wherein it says that FITL can be paid by 31st March 2021. So in that case, 90 days counting will start from 1st April. So the account need not be marked as NPA just because FITL is outstanding. But at the same time, you have to make a provision against that FITL outstanding portion also. Another relief was similarly provided for easing of working capital finance. So wherever the reduction in margin was done, that the reduction in margin was permitted till 31st August 2020. Temporary enhancement in drawing power calculation was permitted to be there till 31st March 2021. So same way the benefit simply has got extended. And asset classification benefit was again given. The status quo was extended till 31st August 2020. So when you're counting that 90 days portion, you have to exclude the period between 1st March till 31st August. So any account which is PA on 29th February 2020, that will remain into 31st August, that will remain into PA category up to 31st August 2020. Similarly, for resolution framework related accounts, that is June 19 circular related account, review period of 30 days will now exclude the period of these 6 months, that is from 1st March to 31st May, and similarly 180 days will also exclude the same period. So the next circular is 6th August circular. Before that, let me just take up the query. Provision to be made against FITL loans or only which are not paid till 31st August. Sir, when I'm talking about provision for FITL, I'm just talking about accounting treatment. In IRAC circular, it has been made amply clear that whenever interest gets converted into a separate credit facility, which is nothing but a funded interest term loan facility. So in that case, since the interest is not service in real sense, it's interest servicing by way of passing a journal entry. So in that case, what RBI stipulated is, wherever there is a FITL concept is there, you have to make 100% provision against that. And as and when FITL gets paid off, to that extent, income will get recognized. So it's not really a provision of BDDR asset, it's a provision against FITL portion. So that FITL amount which is outstanding as on 31st March, just verify whether the provision is made or not, because that is something which is not realized interest. So it's not a deferment actually. It's a new credit facility which is sanctioned. That's why I said that deferment is different and FITL concept is different. So you have to ensure that provision is made by the bank and adequately disclose also in notes on accounts. Let's come to 6th August circular. When we are talking about 6th August 2020 circular, there are eligibility conditions which are given and there are ways to restructure the account which is also mentioned by RBI. So wherever any of these conditions are not met, it means that even though the restructuring is taking place, you have to mark that account as NPA. Wherever the eligibility conditions are met, it means that you can retain the class of asset. So the entire summary or entire benefit under resolution framework is to retain the class of asset in spite of having that account restructured. So that is the whole thing. Now let's first see that which are the exposures which are considered as not eligible under this circular. So here the benefit under the circulars are not available. First one is MSME borrower account which are having aggregate exposures up to 25 crores. So here, even though they are not eligible under this circular, they are eligible under 6th August MSME circular. Second ineligible exposure is farm credit. So as far as farm credits are concerned, you have to apply the master directions related to relief measures. So natural calamity circular is required to be applicable for farm credit, and a farm credit cannot be under this resolution framework. Unfortunately, just to make my point clear, COVID-19 pandemic till date is not declared as natural calamity. So unfortunately for farm credit, there is no benefit of restructuring is available under COVID-19 parameters. Then loans which are given to PACs and FSS for onward lending, they are excluded. Exposures to lending institutions, to financial service providers are excluded. Exposure to central, state or local government bodies are excluded. Exposure to housing finance companies is excluded. Seventh one is interesting one. All staff loans of the bank are excluded from this resolution framework. So their restructuring is not possible. If restructuring is done, it means that that account has to be taken to NPA category. Now, as far as eligible exposures are concerned, they are divided into two parts. One is personal loan, another one is other than personal loan. So first condition under personal loan category is that it is made applicable only to pandemic affected borrowers. So as an auditor, you need to ask the bank to demonstrate before you as to how the bank has ensured that the borrower was affected due to pandemic. Now, this is something which is going to be a very tricky criteria, because you cannot simply say that I am making this applicable to every account holder. So let the bank demonstrate before you as to how they are determining whether they are eligible by way of virtue of pandemically affected one. Second one is that every bank is required to have a board approved policy on record, and the bank will get governed by that policy. So you have to refer to that policy and verify whether the scheme is implemented based on that. The reference date of outstanding amount will be of 1st March 2020. And fourth condition is very crucial one, that the account should be standard account on 1st March 2020. And not only that, that the account should not be in default for more than 30 days on 1st March 2020. It means SMA1 and SMA2 accounts are excluded from this eligibility criteria. So if you have a SMA1, SMA2 account, which is restructured under this circular, then the retention of class benefit is not available, that the accounts is required to be downgraded. So only good accounts which are there, which are outstanding not for more than 30 days are covered under this particular circular. Fifth one is that the borrower has to retain the class of account as standard account as on the date of invocation of resolution plan. And what is the date of invocation? That is the date on which both borrower and lender are agreeing to proceed with the resolution plan. And the last date of invocation was 31st December 2020. And resolution has to be implemented within 90 days from date of invocation. Otherwise, it will be considered as lapse. Now, what kind of a resolution plan it can be? Practically, it can be a reschedulement of payment in various forms. So you can have moratorium period up to 2 years, which can be granted. You can have extension of repayment period, which can be granted. In the sense, tenure can be extended. You can have EMIs reduced by way of that. You can have ballooning of EMIs also, which is possible. You can also have conversion of interest accrued or interest to be accrued in future into another credit facility. And wherever the moratorium period is granted, it will be applicable prospectively from the date of implementation of resolution plan. Now here, friends, you need to keep one thing in mind, that this moratorium period is not supposed to be given as a blanket benefit to all. Bank has to again demonstrate as to why moratorium period was required and when it will be discontinued. Just to give a simple example, bank may say that someone has lost his job due to this COVID-19 pandemic, and that's why the moratorium period is granted. That is a very much valid logic. But if you see that the income source is intact, the borrower is otherwise normal, and the bank is keen on giving moratorium period, that is something odd. So there has to be a viability and reasonability as to when the moratorium period is granted to the borrower by the bank to the borrower. Now, when this resolution plan can be really said to be implemented, there are 3 conditions which are set out by RBI, and the second condition is very crucial. First condition is a normal one, that all related documentation by way of execution has to be completed by that particular date. Second one is that the change in terms and conditions of the loan should get duly reflected in books of the lender. What it indirectly means is your master data should also get updated. Then only you can say that the plan is implemented by the bank. Now, this is something which is going to be a challenging thing for the auditors and the banks to verify also. And third is normal one, that the borrower should not be in default as per the revised terms. So if these conditions are fulfilled, you have to say that the resolution plan is implemented. For other exposures, for single lender exposure, the board approved policy will govern the implementation of the resolution. But for multiple lending institution scenario, the resolution plan has to be considered as invoked only if 75% in value terms and 60% in number terms of lending institutions are agreeing to invoke that. So then only the plan can be invoked. Once the plan is invoked, the invocation has to be before 31st December and implementation has to be within 180 days from the date of invocation. Again, over here, moratorium up to 2 years is permitted. Sanction of additional credit facilities is permitted. Then there is one, you can say, stipulation which RBI has put in, that for multiple lending institutions, inter-creditors agreement has to be signed by all the lenders within 30 days from the date of invocation. Otherwise, the invocation will be considered as lapsed. One more thing which is made or stipulated by RBI is that whenever you are talking about these other exposure, that is other than personal loan, bank has to ensure that the proposal is viable. That viability is required to be established based on financial parameters. So there is an expert committee which was formulated by RBI, and that expert committee has given a report, and that report has got published by way of circular dated 7th September 2020. That expert committee report gives range of financial parameters for sector specific thing, and there are generic financial parameters also. So the borrower has to fulfill those financial parameters to avail this benefit under this resolution plan. And there are two additional conditions for large borrower accounts. So wherever the aggregate exposure is above 1,500 crores, the weighting of this resolution plan is required to be done by this expert committee. And whenever the exposure is above 100 crores, you need to have an independent credit evaluation done by an independent credit rating agency. So both these conditions are also added up for exposures above 100 crores and above 1,500 crores. As far as additional facilities are concerned, if they are given, they will be considered as standard asset. But if the resolution fails, that is the implementation fails, then it will be treated as per the borrower status. So if the borrower is NPA, even the additional facilities will be also considered as NPA. If the account gets slipped to NPA category between date of invocation and date of implementation, then in that case, after the date of implementation, it can roll back to standard asset category. So that benefit is still retained, and the retention of class of asset is extended, under this particular scheme. But let's take a classic case that you have other than personal loan, wherein the plan is invoked on say 31st December 2020, and it has got implemented on 15th April 2021. But by 31st March 2021, the account is under NPA category. So the account has to be under NPA category on 31st March, but on 15th April, it can roll back to standard asset category, using this particular benefit of upgrading the account to standard asset category on the date of implementation. Let me just take up the query before I talk about provisioning. Can you support your point with reference to RBI circular for categorizing PA only after zero overdue? Sir, I have already mentioned the particular paragraphs, that is para 4.2.2 and para 4.2.5 of the circular, which talks about this categorically. Besides that, there is a communication which RBI is doing many times with the institute also, wherein zero overdue status is required to be achieved as far as upgradation of the account is concerned. You can also refer to the guidance note of CA Institute, which also talks about and gives a guidance very clearly and categorically about this zero overdue status for upgradation of the account. Okay, coming back to the resolution framework. As far as the provisioning is concerned, for personal loan, the minimum provision required is 10%, or it can be a provision beyond that. The provision as on the date of implementation or 10%, whichever higher, has to be continued. For other exposures, if the integrators agreement is signed within 30 days, the provision as on the date of implementation or 10%, whichever higher, should be there. If integrators agreement gets signed after 30 days, then minimum 20% provision is required to be provided for. As far as reversal of this provision is concerned, half of the provision can be reversed when 20% of the residual debts are paid, and balance half can be paid after repayment of further 10% residual debt. And here actually you need to keep one thing in mind, that we are presuming that the account is not slipped into NPA category, it is still under PA category. For other exposures, if you are a signatory to integrators agreement, then it is same like personal loan. But if for non-signatories to integrators agreement, it will be based on IRAC provision, which they have to continue with the provisioning norms. As far as post-implementation performance is concerned, for personal loan, normal IRAC norms will apply based on their revised terms of payment. But for other exposure, there is a concept of monitoring period and review period, which is there, which is very critical. If for other than personal loan, typically business loans, there is a monitoring period which is defined. So the period is between the date of implementation and payment of at least 10% of residual portion, and it will be subject to minimum 1 year from commencement of first payment of principal or interest portion. So 1 year is a minimum one, or it can be on a higher side depending upon how the repayment schedule is defined. Now during this monitoring period, if there is a default which occurs, and default can be, as I earlier said, default will 1 rupee or 1 day also, then in that case, 30 days review period will be triggered. During the review period, if the account is not regularized, then the account will be downgraded to NPA category. So the default, if it occurs, the borrower is supposed to make good that default within that 30 days, that monitoring period, so trigger period, sorry, review period. So that is a very critical part. So as an auditor, wherever you are looking at the other than personal loans, be very critical about that. You need to verify as to how the default period, how the default is monitored, how the review period is triggered, and within the review period, if the amount is not regularized, you have to mark that account as NPA. Disclosures and credit reporting. Disclosures, there are formats which are given in the circular for quarterly and annual disclosures. Credit reporting, RBI has issued a circular on 12th March 2021 about what kind of nomenclature has to be given. But RBI has been very clear that restructured under COVID-19 guideline is what will appear in the credit score. So it's a kind of a tame thing which anyway is going to happen for accounts which are getting restructured under this resolution framework, even though the asset categorization, that is standard asset continuation benefit is made available to these account holders. Then we have few important circulars. I will just quickly go through that. We have 21st August 2020 circular, which talks about ad hoc limits, short reviews, and renewal of credit facilities. The same thing which we discussed earlier, but RBI has reiterated that. Then we have another circular dated 21st August 2020, which gives a new definition of MSME with respect to RBI circulars, and clarification is also given in that circular. So just go through that. 14th September circular is kind of an interesting circular, which has asked the bank to automate the process of IRAC compliance through CBS system, and the cutoff date given is 30th June 2021. Why I'm saying interesting is, I'm saying interesting on two counts. As far as I recall, RBI had given a similar circular in 2011, not really a circular, but it was an inbox communication through email which was given to all the banks to automate the process of NPA or NPA marking. All the banks had responded long back in 2011 that auto marking of NPA is done. Reality is altogether different, which all of us know. But anyway, again, RBI has reiterated that. It will be interesting to see that how that 30th June deadline is made by the banks. Another point is that if you happen to come across instances wherein there is a manual intervention of bank which is done in case of NPA identification or income recognition or provisioning, make it a point to mention that in your LFAR, because 30th June is anyway nearing, and all the banks are giving a kind of scenario that they are already equipped with auto marking process. So just pay a little more attention to that. Next one is 3rd September 2020 interim order, which was issued by Supreme Court. The order was a one-liner order which talks about the accounts which were not declared as NPA till 31st August 2020 shall not be declared as NPA till further orders. It was 825/2020 writ petition, a civil court writ petition filed in Supreme Court by one Mr. Gajendra Sharma. On the with relevance to which this interim order was passed. As far as this interim status quo non-declaration order, I should say, is concerned, Supreme Court has 3 days back come out with a decision that this dispensation is no more applicable. So as it stands today, as an auditor, the job is much simpler. You have to presume that there was no such order which was really existent, and you have to simply follow the IRAC norms. That's the real summary which I can make out of that recent Supreme Court judgment. But to go a little deeper, we have our guidance note which was issued prior to this Supreme Court recent order. So para 11.370 in the guidance note is talking about this interim order. So you need to just upgrade yourself with the recent order which was passed by Supreme Court. Institute is likely to come out with clarification related to the recent order also. That will be anyway made as an announcement or whatever it is. In some form it will come from Institute side also. So go by that, but just to put it in simple words, follow the IRAC norms as they are. No relaxation is there from Supreme Court. Keep this thing in mind. Provisioning, income recognition, everything has to remain intact. We have a little more time, so I will just like to go through a few of my slides. I won't be covering in entirety, but I will just touch upon a few of those things. So I just want to touch upon projects under implementation, a few guidelines related to that, and I will touch upon the recent changes which have occurred related to that. So as all of you are aware, project loans are term loans which are given to set up an economic venture. So essentially it is not including CCOD facilities, because the CCOD facilities, once they come into play, it means that the particular project has started with a commercial production. So the benefits of related to project loan are not applicable. As we discussed earlier, project loan will have a DCCO and DC, which will be spelled out at the time of sanction of the loan. If the DCCO is not met, then the account will turn into NPA category. So it's something more or beyond normal 90 days delinquency now. So there is a relaxation also which is given in multiple forms. One form is to do a restructuring and return the class of asset. In the cases wherein there is a change in the project, so wherever there is a change in cost is there, which is increasing because of maybe technological advancement, but which is excluding the cost overrun. And if it is going beyond 25%, or it can be a case wherein the scope and size of the project has been extended beyond 25%, then in that case, it has been permitted by regulator to entirely relook at the entire project. So you can have additional finance given, you can change the repayment schedule, you can change the DCCO, everything is possible, provided that the reassessment of viability is done by the bank. So here, restructuring is possible with retention of class of benefit. If something is going beyond that, like for example, if your increase in project size and scope is not beyond 25%, but still you go for this restructuring, your account is required to be downgraded. Second point is that the deferment of DCCO is also permitted. So to the extent of DCCO extension granted to a particular borrower account for project loan, extension for repayment period can be also granted equivalent to that period. So suppose you extend DCCO by 2 years, you can extend the repayment period by 2 years. If you go beyond 2 years extension period for repayment, it means that the account has to be downgraded. Now, extension of period, this table is just to give you an example of how that extension is possible. So without giving any reasons for infrastructure loan, merely on the basis of borrower's request, 2 years extension is possible. Non-infra, 1 year extension is possible. Court case, additional 2 years are possible for infra. Any other reason, additional 1 year is possible for non-infra as well as infra project. Now, the change which has occurred is by way of 7th February 2020 circular. By way of this circular, this benefit is now also extended to CRE project loans. Earlier, commercial real estate project excluded from this benefit. So now DCCO extension of 1 year is also granted for CRE project. So that's a new thing which has been brought. Additional provision of 5% is required, even though the retention of class benefit is there. Wherever DCCO is extended beyond 2 years, you have to make additional provision of 5%. Then one more case is that whenever there is a change of ownership is there, additional 2 years extension of DCCO benefit is permitted. It's a one-time relief. Wherever the change of ownership happens beyond 51%, new promoter should own beyond 50% as compared to the earlier structure, and the new promoter should not be out of the group concern. So that is a basic requirement. Another point is about financing of cost overruns. So typically, as we can think of, is wherever you are financing for cost overrun, it amounts to a kind of a restructuring. But here actually for project loans, what RBI stated, banks are permitted to finance the cost overruns also, subject to certain conditions, two fundamental conditions. First is that the other cost overruns should not be going beyond 10% of original cost. And secondly, the standby credit facility for this financing of cost overruns has to be used only for cost overruns and not otherwise. So it should not constitute to a ever-ending case. So it should only fund the cost overruns, and it should not be used to regularize a normal account. So these two fundamental conditions, one is to fulfill. Other norms of income recognition and provisioning have remained same. I will just reiterate few of them. As far as the income recognition is concerned, for NPA accounts, the income should be recognized on realization basis. For PA account, it has to be always on accrual basis. Whenever you mark an account as NPA, unrealized portion of interest, fees, commission, charges, which has remained unserviced, that portion has to be reversed or provided for. FITL, as we discussed earlier, it has to be provided for on 100% basis, except in cases wherein your interest gets converted into a marketable security, that is a listed security. So in that case, that portion will be considered as realized to the extent of market value of the security on the date of conversion of interest into that. Order of recovery, there is a discretion available with the bank to decide about order of recovery. But typically, the banks are first recovering expense, then interest, and then outstanding principal portion. But here, you need to keep one thing in mind. Based on the discretionary criteria available with the bank has to disclose that in notes on accounts, and it has to be applied in uniform and consistent manner. Classification norms have remained same about the period for that, which we discussed in initial part itself. Provisioning for standard asset, there is no change. Similarly, provisioning for substandard asset, it is same 15% for secured loans, 25% for unsecured loan, 20% for infrastructure loan, which are backed by escrow facility having a first charge. DA1, DA2 also same. Unsecured has to be provided on 100% basis. Secured portion has to be 25% for DA1, 40% for DA2. DA3, you have to make 100% provision. Loss asset, you have to make 100% provision. Intangible security will not include trademarks, rights, licenses, brand names. That portion will be considered as unsecured one. Country-wise exposure norms and risk related to that and provisioning requirement, no change in that, but typically this will be taken care at the head office level, not really at the branch level. Special circumstances benefits are there related to ECGC guaranteed accounts, wherein the provision is required to be made only to the extent of excess of amount, amount which is in excess of the guarantee which is provided. Takeout finance, again, there is no change. So it's a typical arrangement between the banks wherein the account is taken over under a pre-agreed term by the other bank. So if the account turns into NPA in the first bank, that NPA date will also get carried forward to the second bank. And like that, it will continue from one bank to another bank. Post-shipment suppliers credit, if it is backed by Exim Bank's guarantee cum refinance scheme, no provision is required to be made because the guarantee claims will get settled within 30 days. Export project finance, just to reiterate, export project finance, if the exporter in India has exported certain goods or services outside India, and if the importer of that country is not able to remit those funds to India because of certain regulatory restrictions which that country has imposed, then the exporter has to open an account in that country, receive those funds in that country, and then he gets an extension of 1 year period to bring back those funds back to India. So that is a relaxation which has continued as it is. Restructuring norms have remained same. So practically restructuring is possible at any stage. Only thing is that it has to be done it cannot be done retrospectively. It has to be on the basis of borrower's initiation. So suo motu restructuring is not possible. Fraud cases restructuring is not possible. Stage of restructuring can be at any point of time, before commencement of commercial operation, after commencement of commercial operation, account when it is PA, NPA, at any level it is possible. But whenever restructuring takes place, except the cases which we discussed, in all other cases, standard asset has to be downgraded to substandard asset category. NPA account will slip further to lower category. You have to make additional provision, on such accounts in the form of sacrifice beyond, normal IRAC norm provisions. And there is a satisfactory performance criteria which RBI has defined. So if an account demonstrates a satisfactory performance for next 1 year, account can be upgraded. This is the satisfactory performance criteria, which is very liberal. That an account which is downgraded because of restructuring, it can be upgraded, provided that the account is within the limit by the end of 1 year, and it has never been out of order beyond 90 days. That is, it is never overdue beyond 90 days. For agricultural loan, a simple criteria that it has to be within the limit by the end of specified period. Provisioning requirement, sacrifice calculation is required to be done. Sacrifice calculation is done on the basis of discounted cash flow method. So you have to compare the old cash flows, cash inflows, with the new expected cash flows based on the revised repayment schedule. When you arrive at the present value, if the new present value is adverse as compared to the original present value, the differential is called as sacrifice, and you have to make a provision for that. Interest rate which are applicable to that particular account holder will be considered as discounting rate related to that calculation of DCF method. Special regulatory treatment, as I already discussed, it is dispensed of with effect from April 2015. So except for COVID-19 circulars and project loan cases and agriculture relief measures, in all other cases, wherever restructuring happens, you have to downgrade that. A simple litmus test of restructuring is given in Annexure 5 to the circular. I will show that definition at the end of these PPTs. These are the circulars which are abolished. That is 38 January 2014 circular, like flexible restructuring for long-term infra project, SDR, S4A, everything has been dismantled. 12th February circular is also dismantled. So in the next slides, even though it talks about all these circulars, it is just for your reference purpose. Right now, the applicable circular is June 19 circular, which talks about the prudential framework for resolution of stressed asset. I'm not going into detail into that. I just want to highlight two parts of that. One is SMA categorization is mentioned. That is how to categorize SMA 0, SMA 1, SMA 2 for term loans as well as CCOD accounts, and how to report that. So there is a correct reporting for borrower accounts which are above 5 crores. So as an auditor, you need to also verify not only NPA status, but SMA status also, and you need to verify that whether the SMA status has been reported to CRILC or not. Implementation of this resolution plan is limited. So 2000 crores and above got effected from 7 June 2019 itself. 1500 crores and above accounts from 1st January 2020. Loans which are below 1500 crores, normal norms which are there in July 2015 circular will apply, which we talked about earlier. So I will just show you one more slide that as far as asset reconstruction companies are concerned, whenever the NPA accounts are sold to ARCs, certain norms are specified about how to value the security receipts. So those of you who are doing asset recovery branches, ARBs, it's a rare case actually we get ARB branches, but wherever you are there doing those branches, just refer to this part of the presentation. I'm not getting deeper into that for the simple reason that it's not a normal thing and we are also running short of time. I just come to the end actually, few points to reiterate. Para 4.2.2 talks about banks establishing their internal systems to identify the accounts as NPA. Para 4.2.5, which talks about recovery of arrears of interest and principal to make that account to a standard asset category. That's where the entire overdue portion recovery is mentioned. Annexure 5 gives you a definition about what is a restructured account. So this is the account wherein the bank, for economic or legal reasons related to borrower's financial difficulties, is granting some kind of a concession. So it has to be due to borrower's financial difficulty and there has to be a concession also. So typical case is that suppose you are having a good borrower account and their rate of interest is reduced because a good rate is offered by the other bank. So it is not because of financial difficulty where the concession is granted. So it is not called as a restructuring. Or it can be a case wherein, say case of housing loan, half interest rate cut is done across the housing loans. This is not a restructuring. Another case is that you're having a OD facility which is converted into a term loan. So this is not a concession because now the borrower is made to pay that amount prior to as compared to the earlier overdraft account. But a case, suppose a term loan gets converted to OD, there is a deferment of payment which is happening. So the borrower concession is extended. So if the borrower is having a financial difficulty because of which this extension happens, it is called as a restructuring. Once the restructuring happens, downgrade that account. Last few things, pay attention to the unique customer ID concept because this is a year when mergers have happened. So the UCIC concept has to be tested by you. Wherever it is a possibility that you have 2-3 consortium bankers who have not got merged because of merger of public sector banks. So you need to take a NPA date, which is the worst date, that is, which is the earliest date, and mark that account as NPA. So the NPA date might also undergo change because of these mergers and related to consortium account holders. So pay attention to that. Also pay attention to the date of NPAs which are carried forward from the last year. Also pay attention to early mortality cases and evergreening instances. Evergreening is something which RBI has been always harping upon. In the recent Eco Survey 2021, also this evergreening has got a mention. And last one is that MOC's main audit report and LFR, they are standalone. They are, even though they are interrelated, they are mutually exclusive from each other. So no one can replace either of them. So suppose you want to pass a MOC, pass MOC, and maybe a commentary can be there in LFR, but you cannot have LFR as a replacement of MOC. Same logic applies to your main audit report also. So with this, I would like to end my session because we are almost through with almost all NPA norms. We can just take a few of the questions if you are there, because I'm already overstepping on the time which is there for the next speaker. So I don't want to really do that. But if question answers are there, we can just take for next 4 to 5 minutes.
Only one question is there, sir.
Sure, sir. Yeah, I will just answer that. In case if there is an advance as well as investment, is the concession provided to advance available for investment? Sir, wherever advances and investments are there, both are considered at par. So if you have an advance account marked as NPA, the investment exposure will also get marked as NPA. There is only one exception to this rule because it's vice versa also. Like if you have an investment marked as NPA, your advance account will also get marked as NPA. One exception to this rule is if you are having an exposure in the form of preference shares, and if the preference shares are marked as NPA, you don't have to mark the rest of the exposures in the form of investment and advances as NPA. So that is the only one exception to this rule. Otherwise, borrower-wise classification norms are applicable equally for advances as well as investments. I presume that you are a central auditor. That's why you are asking this query, because this query is a typical one which is faced by many central auditors. So thanks to all of you for patiently hearing me. I miss out the opportunity to meet all of you in physical mode. But still we are able to connect through virtual mode. So thanks to all of you once again, and over to the management committee and chairman, sir.
Thank you, sir. Thank you so much for your lucid presentation. It's extremely well, and it speaks your command on subject and practical exposure. And once again, very much thankful for accepting our invitation and being here online. I'm sure that as per our previous discussion, you have to be attend Hyderabad, and there should be a great invitation for you from Hyderabad always, sir.
Of course, I will be always there, whether in virtual or physical mode. And since we are live, actually, I don't want to again repeat those things, but we had a long talk about that, and I told you the reasons for that also. So it will be always my pleasure to be there at any point of time, whenever you require for anything you require.
Sure, sir. There will be permanent invitation from Hyderabad Managing Committee, sir. Looking forward to your continuous support for an Hyderabad branch and Hyderabad members, sir. And
sure.
Thanks a lot for accepting the invitation. And sir, as a token of thanks, we would like to request you accept our virtual certificate.
Yeah. Thanks a lot, sir.
Virtual certificate of appreciation. Sure, sir. We'll send it to you in a physical mode also to your address.
Sure.
Thank you, sir. On behalf of the entire managing committee and members of Hyderabad branch, thanks again. Thank you. Over to Satish.
Yeah, thank you, Chairman, sir. With your permission, I'm going to start the second technical session. I welcome all the members to the second technical session.
Before I welcome our second session speaker, A. Moni, sir. Welcome, sir.
Yeah. Second technical session is revealed LFA. And I welcome speaker of the second session, CA Moni, sir, from Calicut. I request CA YV Banarina, past chairman, Hyderabad branch, to introduce today's speaker, please.
Thank you, Satish, Chairman, and my dear colleagues. Today I have the privilege of introducing a chartered accountant who also has the DSA qualification and who has been in practice for 27 years as a partner of Messrs. Shankar and Murthy, a very renowned firm. He authored a book on GST named Handbook for Handling GST Complications way back in 2017 when GST was introduced. He has given several orientation sessions for CAs, professionals, and businessmen all over Kerala on GST. Our speaker today is not only an expert in GST, but also an expert in handling the audit of banks, especially the public sector banks. He has experience in handling 4 statutory central audits of nationalized banks, the State Bank of Travancore, Syndicate Bank, Corporation Bank, and Indian Overseas Bank. And he has the distinction of having signed the global balance sheets of Corporation Bank in 2006-7 and also that of the Indian Overseas Bank in the year 2012-13. He's a very sought after faculty and speaker on various topics on bank audits across several branches of our CA Institute in India, including our Hyderabad branch. He also serves the profession and professional colleagues not only as a speaker and faculty member, but also as a motivator and a leader. He was the past chairman of Calicut branch of ICAI of SIRC. He was also the past president of Rotary Club of Calicut East and also the past assistant governor of District 3210 of Rotary International. This speaks volumes about his leadership capabilities and his service bent of mind. Today, he's going to enlighten us on the very important topic of revised long form audit report, the LFAR. Friends, as it is said, change is the only constant in life. And so we have major changes in reporting in LFAR from this year onwards. Who else can enlighten us better than Mani Ananta Shivan, chartered accountant, and he is the best choice for handling such an important topic like the major changes in reporting in LFAR. Mani sir, your name is Mani, which means a gem and a jewel. And in common parlance, money is again money, the well known source of income, which we are all familiar with. It is said that money makes many things and money makes so many things. And banks are very important for our country and economy because banks create wealth and wealth management through lending of loans to the industry and several MSMEs. Health of banks is very important and crucial. And as auditors, we need to certify not only the wealth of the bank, that is its assets and profitability, but also the health of the advances, that is how strong and how productive and how performing the assets are. And this is going to be a very challenging task for our CAs, especially because this year we have to report a lot of things that will go to improve the health of the banks through our reporting in the LFAR. Friends, it is my proud privilege to introduce a worthy chartered accountant, Mani Anantasivan. Thank you very much.
Thank you, Bharat. Mani sir,
Thank,
now
th-
the feeling
thank
is-
you, thank you. In fact, my video just has gone down. Absolutely. Yeah, can I start? I think I am audible.
Yes, sir.
Yes, sir.
Yes, sir.
Yeah, I will just share my screen first. See, thank you very much for a very beautiful introduction in the morning. In fact, it is actually, he told me that money is everything, but money also destroys something somewhere. That is also very important. So, I am reminded of a song. In 1989, there was a song called Money, Money, Money. It's so funny and it's a rich man's wonder. I don't know how many of you have heard that. Anyway, so it's funny also sometimes, and it makes relationships very dark also if we are having greed against money. Anyway, now the topic here is regarding the LFR. Before going to the LFR, I should be profusely thanking the chairman, Mr. Machar Rao, and Satish and all other organizers who have invited me to this seminar in Hyderabad. In fact, a very dynamic decision taken by the chairman to conduct it virtual rather than making it physical, because in the March 31st, you all know that we have got the deadline of filing the returns. So I was also reluctant to take up physical meetings because my 2 days will be gone. But as a blessing in disguise, Mr. Machar Rao has decided that we should make it virtual. So I am able to have the cake and eat it too, because I am able to address the Hyderabad branch. At the same time, I am getting around 2 days time in my office. So thank you very much. And in fact, always physical meetings are physical meetings. So the pulse of the audience, if we want to feel it, if you want to see the pulse of the audience, and the captiveness of the audience can be felt only when we are physically meeting. But anyway, virtual meetings are also the order of the day where we have to do. Now I have been allotted only 1.5 an hour or 1.5 hours for discussing about a very, very long topic. It itself speaks about long form audit report. I don't know how short I can make it in the long form audit report. Anyway, my duty is to just give you a synopsis of what are the changes which has come in the LFR. So speaking about the LFR, as you all know, LFR earlier, if you look at LFR, we were all taking as a backbencher, which means that we will be taking up the LFR only at the last end, or after finalizing all your IRAC norms and verification, we will be going to the LFR and finding out how we can fill the LFR, or we will be entrusting the job of the LFR with some assistance of ours, where he will be doing the final job of filling the LFR and giving it to us. But now in 2020-21, there is a sea change in the scope of completing the LFR as such. The sea change is that there are a lot of new modifications and additions which has been brought in the LFR, which in fact makes the auditors fix up the responsibility by themselves. And the auditors are inviting the responsibility by themselves to see that they are required and instructed to report about so many factors in the LFR. It is not that you just fill up the LFR, but you are also supposed to go back and you have to go deep into the accounts and you have to give discrete reporting. You cannot run away from reporting. And the reporting also should not be, as you all know, reporting should not be in a haphazard manner that it is available or it is not available or many of the accounts are not correct. It is not the way in which is being asked. It says that you have to discreetly report about the account number. You have to discreetly report about the details of the accounts, like the account balance and the date of NPA. All these things are being very clearly asked in the LFR, which means, and many cases, tables are also given. Tables are given to give the full details of the accounts that you have verified, which means that you will not be able to shift away from the responsibility of not reporting. So before going into the LFR, the modifications are made in such a way that it involves or it attracts or it totally drags the auditor to put a full effort in the filling of the LFR and completing the LFR. So the major changes, if you look at the major changes which has happened in the case of LFR, is regarding the advances. So advances portfolio has totally been changed to see that the scope of verification of individual advances itself has been totally changed. If you look at the scope of verification of individual advances, it says that you have to verify the 10% of the non-fund based and fund based advance of the branch, or 10 crores, whichever is less. Which means that earlier, up to last year, our scope of verification of individual accounts were totally different. It was 2 crores or 5% of the total advance of the branch. So that is now totally changed. It says that you have to find out what is a fund-based balance and what is a non-fund based balance. You have to add up the fund-based balance plus non-fund based balance and find out what is a total fund-based plus non-fund based advance of that particular branch. 10% of that is one benchmark. Another is 10 crores. Whichever is less. So any account which falls, whichever less than this particular criteria, or any account which falls in that particular benchmark. Take the case of a branch which has got an advance of around 150 crores. And it has got a 50 crores non-fund based. Totally fund based plus non-fund based is 200 crores. So your 10% of 200 crores is 20 crores. And the other benchmark is 10 crores. So any account which is above 10 crores or 20 crores, whichever is less, has to be individually verified. So individual verification scope has been changed from 2% or 2 crores or 5% to 10% of the fund based plus non-fund based, or 10 crores, whichever is less. That is very, very important. So the major change which has happened is in respect of selection of that particular trust to be given about the individual branches. It says that advance verification and accounts verification has to be done in two phases. One is that you have to select the benchmark. The benchmark of the account has to be selected, as I have told earlier, 10% or 10 crores, whichever is less. Once that is selected, then you will have to go to the other accounts. And it also specifies that how you should be approaching the other accounts verification. The other account verification has to be approached in such a way that you have to conduct a process verification, which means that the overall process verification has to be reported and commented by you in respect of other accounts. So you are not left with the verification of only these specified accounts, which is coming under the benchmark policy. So beyond the benchmark policy, if any account is there, or any account, or I would say that all the accounts which are not coming under the benchmark, is to be done a process audit. Now, what is being done in the LFR is that they have very clearly defined what is a process audit and what is a transaction audit. It says that in respect of those accounts where the individual verification are expected by the chartered accountants, you have to do a transaction audit. I repeat the word transaction audit. So transaction audit is something which we have to go little deep into the account verification. How do you go deep into the account verification? You have to know what is a transaction audit. Transaction audit includes verification of the individual transactions of the account, which means that you cannot just like that find out whether the account is overall verification of the account is completed by verifying the IRAC norms and verifying the other intricate norms of the Reserve Bank of India as well as the bank policy or the procedures of the banking industry. But you should go beyond to see whether the individual accounts are properly being aligned with the RBI directives as well as the RBI regulatory initiatives. So that is causing and that is attracting lot of onerous responsibility on the auditor. Supposing that you come to select a particular benchmark account, you will have to go into the transaction analysis. How do you go into the transaction analysis is that, first of all, you should be able to know the business of the customer. That means that if you are going to be auditing the branch, we were all taught to be only knowing the business of the client. Knowledge of the business of the client is that you have to know the business of the bank or the branch. But today, if you want to do the transaction audit of the customer of the bank or the branch, what is required is that you should be knowing what is the business profile of the customer of the customer. Or I would say that business profile of the client of the client. Or I would say that the business profile of the customer of the branch, which means that you have to go one step ahead in understanding the business profile of the customer of the bank and align that with the conduct of the account. The conduct of the account has to be totally aligned with the business profile. Take the case of a retailer. In the case of a retailer, the account operated in the bank will have only cash remittances. So the deposits will be cash remittances because he will be receiving only piecemeal in cash. So the cash sales will happen more. The component of cash sales will be more, which will reflect in the account as cash deposit as more. So more cash deposits are expected in respect of a retail trader. Take the case of a wholesale trader. In the case of a wholesale trader, it will be actually 70 to 75% of your cash deposit will be very much limited because your major transactions will be only through bank, because you have got a blanket restriction that you will not be able to accept more than 2 lakh rupees cash in a single transaction or in a single event as per the Income Tax Act. So coming to the Income Tax Act and compliance with the Income Tax Act, you know that in respect of a wholesaler, if the customer of the branch is a wholesaler, the wholesaler's account should be of more of accounted transactions, that is transfer or RTGS or NEFT, or the cash component in the particular account should be less. And take the case of your cash component of debit side or credit side. As I told you earlier, in the case of a retailer, you find that the debit side of the account will be more of cash deposits, and the credit side of the account will be payment to the suppliers or payment to the creditors. So it will be all be in the mode of your RTGS or NEFT. So on one side, you will have cash transaction. On the other side, you will have e-transaction or the banking transaction, which means that if the account is not operated according to the normal business profile, if you find that the account, a retailer's account, is operated with all transfer deposits, which means that your bulk deposits are coming. How can you expect a retailer to have one single sale or one single deposit? It means that other than cash deposit, it means that he is holding a cash deposit account with some other banks. So some other bank, he will be maintaining a cash deposit account. From that account, the total cash deposited will be transferred to your main account, your CC account or OD account, or your base branch will be transferred, which means that the deposits are coming from another bank as a transfer, which is not a practical probability in respect of a retailer. In respect of a retailer, if you are doing a direct banking, the amount of deposit has to be only in cash. So if there is a inconsistency in respect to the conduct of the account, there comes the importance of your transaction. So if you find a retailer's account where it is also set under this particular benchmark, you have 10 crores or 10%, and if you have selected that particular account for transaction audit, you have to see whether the deposits are mostly cash. If the deposits are not cash, then it is a matter of concern because it is not going according to the profile of the business as we have understood in respect of that particular retail customer. So that retail customer of the brand should have cash deposits. That is an ideal situation. So if there is anything which is abnormal, you have to understand and identify why that particular retail customer does not have cash deposits and what is the reason that it is coming as a bulk transfer from some other account. So that is a flaw in the conduct of the account because the Reserve Bank of India has very clearly told that there cannot be an account opened by any person, any borrower who is having a loan account with a bank should not have a parallel current account with any other bank. And all banks in India are also instructed by the Reserve Bank of India to close the current accounts wherever the borrower or the customer has got another loan account with any other bank. Supposing that your main account is with the PSP, that is Canara Bank, and the limit is enjoyed in Canara Bank. And if you hold a current account parallel in HDFC, the Reserve Bank of India blanketly says that you have to close the account. You cannot operate one current account in one bank and your OD account and CC account in another bank. So that is a very, very important restriction which has been imposed by the Reserve Bank of India, which is more relevant in the year 2020-21. So if the conduct of the account, supposing if it comes under the benchmark, and if you feel that the account is operated in another bank also, then it is a matter of concern of transaction audit. So the auditor has to verify whether the transactions put through are in align or in synchronizing or in sync with the transaction profile of the borrower. If the transaction profile of the borrower, as we understand ideally, and the account operation are not matching, then it is a matter of transaction audit. Then it is a matter of transaction verification. Then you have to report that there is an inconsistency in respect of the conduct of the account. Maybe it is a performing asset. If at all it is a performing asset, it is required that the conduct of the account has to be aligned and in sync with the business profile of the particular customer. If it is not there, it requires that, and the account is having a huge portfolio of 10 crores and above, and it comes under the benchmark, then it requires the transaction audit of the audit. Then coming about the personal transactions. If you look at the personal transactions, you find that the debit side of the account is totally the credit card withdrawals. The credit card withdrawals on account of textile shop purchases or your cash withdrawals or petty cash withdrawals. So the ATM usage, if the accounts are more utilized for the purpose of personal transaction than business transaction, or the component of your personal transaction is more in that particular account, which is coming under the benchmark, it is a matter of transaction audit. So you have to report that the personal transactions are more rooted in that particular account, which is also a deviation from the required norms of conduct of that particular account. If you are having an OD account or CC account, it is ideally required that you should be conducting that account more for the purpose of your business transaction, not for your personal transaction. So if you find that a personal transaction, take the case of a housing loan. If you are paying housing loan from your CC account, it is pure diversion of fund. Supposing you have constructed a huge fabulous house of 5 crores, you have taken a housing loan from HDFC or any other bank for that matter, and you have got a business current account or business cash credit account with this Canara Bank or any other PSB. So when you are going to audit that particular account, you find that a huge amount of installment is meticulously going to the other bank, which is a personal transaction. It is diversion of funds only. So in the case of that particular personal transaction, if it is material that it amounts to diversion of funds from the working capital loan given by the base branch, it is a matter of transaction audit. It is a matter of verification, and it is a matter of reporting by the auditor. Take the case of your check returns. The Reserve Bank of India also has said that if an account is showing any incipient weakness in the regular conduct of the account, then it has to be classified as SMA 0. That is a special mention account 0. We all know about special mention account, that is SMA 0, 1 and 2, decides the conduct of the account and the irregularity or the delinquency of conduct of that particular account. So check returns are also a matter of concern in respect of transaction audit. If you find that the account is full of debit and credit of the same amount, which means that it is a check issued and check return, check issued and check return, or even the check which is received by the customer of the borrower is returned again and again. That is also showing an incipient weakness in the conduct of the account. Supposing that I have got an account where my checks, whatever checks I issued are returned. If I am the borrower, and the transaction audit of that particular borrower account is selected by the auditor, and if you find that the checks issued by me are returned with recklessly without following any cash flow analysis, which means that or I am issuing checks without analyzing any cash flow analysis, then it means that it is a conduct of the account is not correct. So it has to be classified as SMS 0. It is a delinquent account. It is an irregular account. So the transaction audit has to be focused on individual transactions and the conduct of the account. Now coming to the frequent outdrawings. In the case of those accounts where the account is operated at the brim, supposing I have got a limit of 10 crores of, and if you find that always the account is operated at 9.9 crores and again 10.05 crores and coming back to 9.9 crores throughout the year, if you find that, and it is just technically escaping out of the NPA. So technically it is not an NPA, or it should not be classified as an NPA. But here what is required is that you should do a transaction audit. When you do a transaction audit, you find that the account is operated at the brim. What does it elude? What does it elude? If the account is operated at the brim, the illusion is that either the working capital cycle or the working capital requirement of the borrower has not been apprised by the bank. The working capital requirement should not have been or might not have been apprised by the bank properly. If that be the case, the account will be always under stress because he will be operating under the brim. Or I am having a working capital requirement of 15 crores and I am sanctioned by the bank only to the extent of 12 crores. I will be always in short of 3 crores of rupees. So the appraisal of the working capital is very, very important. And especially in the COVID situation, what is required to the banks is that in order to alleviate the stress due to COVID, every bank is required to redetermine the working capital cycle and the working capital gap. Accordingly, the stress release measures has to be adopted and implemented, and they should be given as a relief to the customer, but within the parameters of the relief package. That is the regulatory package 1, 2, 3, 4, and 5, as elaborately discussed by our Dhananjay Saab. So what I am trying to tell you is that you will have to do the transaction audit in respect of frequent overdrawings and account operated at the brim. And if you find that there is incipient weakness about working capital appraisal or incipient weakness about planning of the customer in respect of working capital or cash flows, that is also a matter of concern because it is coming under the transaction audit. So transaction audit requires that you
Satish? Satish? I think there was a technical problem from the end of the speaker. Sir, got disconnected. I think there is a technical problem with your end, sir.
not technical problem. My power has failed. So I have now connected to generator.
Okay, please, sir, please.
I have asked them to connect to generator in the beginning itself, but they did not do it. Okay.
Please carry on.
Can we continue?
Please, sir, carry on.
Yeah. Sorry for the interruption. Now, in the case of transaction audit again, what is required is that you have to go to such accounts where there is frequent overdrawing. Frequent overdrawings is also an incipient weakness in the conduct of the account. So supposing that I am taking TODs. TODs are permitted only for 12 times a year. Supposing an account is taken or a particular borrower account is granted, or if he is availing TODs more than 12 times, it is an incipient weakness in the conduct of the account. It is a matter of transaction audit and to be reported by the auditor in the LFR. Now coming to the transfer to another bank, take the case of your balance sheet. You take the case of a borrower and you verify the balance sheet, audited balance sheet of that borrower. You find that the borrower has got bank accounts with 3 major banks. And if the transfer is happening between those banks very frequently, you have to see what is the reason for that particular transfer. If the transfers are not backed by or the transfers are not substantiated by business transactions, then it is a matter of concern. It is a matter of very serious concern because I will be holding bank account with so many banks as per my balance sheet itself, and I simply transfer funds from this account to that account and again from that account to this account. So there will be some underlying reason for that, and if there is no underlying reason, that is also very important. So the transfer between the banks frequently within the same customer, and also in respect of group customers, group borrowers. Supposing you have got a group borrower and the account transfer is happening between the group accounts. A particular group of private limited companies or partnerships or family concerns where you have got 5 or 6 business entities. And if there is frequent transfer between these accounts where these are not interconnected or these are not connected otherwise in the normal business. A borrower, a group of borrower who has got a petrol pump, who has got a jewelry, who has got a retail outlet. These are all different business combinations where you need not have to have a fund flow between these two bank accounts. So if you find that the jewelry account money is coming to the retail account and retail account money is going to the petrol pump, all these things, that is the group account is transferring funds between itself, which means that there is an incipient weakness in the management of the funds for the group as a whole. That is to be verified by the auditor and then the transaction audit. If at all it is a standard account, it is a matter of concern for the purpose of transaction audit and it has to be verified. Now, another important point is that the Reserve Bank of India said that the IRAC norms, that is the income recognition and asset classification norm, very clearly says that an account should not be made or should not be stalled from the classification of non-performing asset or classification as non-performing asset by a process of evergreening. What do you mean by evergreening? Evergreening is that if the accounts are not regularized by genuine credits, if the accounts are not regularized by genuine credits, or if the technical requirement as per the IRAC norms are being circumvented directly or indirectly for this purpose of satisfying the technical requirement, then also it is a matter of evergreening. One first typical example is that if I am going to sanction a new loan to a particular person in the CC account and asking him to use that particular CC account additionally given to him for the purpose of regularizing a delinquent term loan account. So an account is, I am having 2 term loan accounts and I am having a CC account. So if the CC account is enhanced and the enhanced facility is utilized for the purpose of regularizing my delinquent term loan account, then it is a matter of concern because it is a matter of evergreening. You cannot do that. So a new facility cannot be granted for the purpose of evergreening or it cannot be granted for the purpose of regularizing a term loan account or a delinquent term loan account or a non-performing asset. That is a matter of evergreening. Second aspect is that if you are going to have an evergreening process by round tripping. What do you mean by round tripping is that example I have told you earlier. That from one group account or one account, it is being transferred to another account. And from the second account, it is transferred to third account. And the funds are transferred from third account to fourth account. Which means that there is a same fund which is being transferred without an underlying transaction between the various accounts for the purpose of evergreening and for the purpose of coming out of the NPA tangle. So for the purpose of coming out of the NPA requirements or for the purpose of coming out of the NPA technicalities, if I am doing a transfer process between the accounts one by one and the same funds are going between various accounts and it is coming back to account number 1. That is account number 1 is transferring 25 lakhs of rupees to account number 2 and the same 25 lakhs is transferred after 3 days to account number 3 and it comes back to account number 1. Which means that it is a matter of round tripping where the same fund are being utilized for the purpose of evergreening all the accounts in the process. Sometimes all the account would be out of order. all the 3 accounts, CC accounts will be out of order. So if the 3 accounts are out of order, if I'm going to do a round tripping, I'll be able to transfer fund from account number 1 to 2 and 2 to 3 and 3 to 1, which means that all the accounts becomes a performing asset as of 31st March. So that is very, very important to be verified by the auditor. So the transaction audit requires that you should be verifying these type of transactions which are intricately connected to the evergreening process. So the evergreening process is very important. So again, it says that the enhancement of the existing loan account for the purpose of regularizing a non-performing asset is not possible. That is also a matter of evergreening. So all these things are to be verified transactions, which means that it attracts a lot of responsibility onto the auditors. Earlier, in the case of your benchmark, your 2 crores or 5%, you are only asked to verify the accounts and advances. And what we will do is that we will be verifying the total overall conduct of the account. We will verify whether it is going according to the prudential norms. We will be satisfying that the account is performing asset, and we will be verifying whether the other procedures in respect of submission of stock statement, insurance, and all these things are okay. And if the account is conducted very well, then we will leave that particular account. But in the case of the new LFAR, it requires that you have to go further deep into the transactions. And if you find that there is any incipient weakness in the conduct of the account, then it is a matter of reporting in the LFAR, which means that your responsibility is increased even in respect of those accounts which are performing. If it is coming under the benchmark, a transaction audit is required, and the transaction audit requires that you have to verify every transaction and the mode of transaction. It has to be in sync with the business profile of that particular customer. And if you find that there is any inconsistency which may lead to an incipient weakness tomorrow, or if which is an incipient weakness as of today, or which may lead to an incipient weakness tomorrow, that is a matter of reporting by the audit. Now again, I will also drag at this point of time to the fraud. It also says that earlier there was only one simple question in the LFAR in respect of fraud. We will come to that particular slide later. It says that the account which or any account which has been detected as fraud in the branch or not. Do you come across any account which has been detected as fraud in the branch or not? That is, throughout the year we were only asked to give one particular report in respect of classifying an account as fraud. But today, aligning with the transaction audit portfolio which is required by the auditors, if I ask you, it says that the transaction audit and your requirement of fraud is aligned together, and in one section of the LFAR, it says that any amount of potential fraud as per the fraud circular which is given by the Reserve Bank of India is also a matter of reporting by the audit. There are around 31 parameters which has been given by the Reserve Bank of India in the LFAR itself. If you go to the LFAR, you come to a lot of other points where it says that the overstatement in the stock statement, the overstatement in the bill receivable statement, falsification of statements which is furnished to the bank, or even falsification of any documents otherwise than for the purpose of a loan furnished to the bank, and your error in your shipping bill, or your falsification of the shipping bill, and your overvaluation of your property. All these things are reported to be a potential fraud. So a potential fraud has to be understood by the auditor, and the auditor should be able to identify those potential fraud, and that has to be aligned in respect of your transaction. So if you feel that the account is conducted in line with the potential fraud, then it is a matter of concern. Supposing that I have got a limit of 10 crores, and my check return, if you look at, I have issued checks up to around 150 crores, which means that I very well know that this 150 crore check cannot be passed. So which means that I am trying to utilize, or I am trying to misuse the check which has been issued by the bank for the purpose of adjusting or for the purpose of deferring some of my payments, which means that I am doing a trade, or I am kite flying the check, or I am flying the check, or the document given by the bank is now used for a kite flying operation. That for the purpose of 1 week or 2 weeks, I am utilizing the check for a commitment of 50 crores, which is much beyond my limit. Then it is a matter of concern. Then it is a matter of concern if a check is issued beyond the capacity or limit of that particular customer, and if it is returned, and if more instances are there, we have come across a peculiar case where the account was operated very well. A very beautiful account and it was operated very well. It is actually a textile dealer. A textile dealer in Mumbai was having a limit of around 15 crores of rupees. This 15 crores of limit account was operated very well. But when we look at the account, we found that the checks of rupees 25 crores, 28 crores, round amount of checks are being issued and returned. Issued and returned. So when there is an issue and return, and the amount of check is huge amount, round amount, the transaction audit was conducted, and we found that what is the purpose of issuing a check, which is having around 28 crores round amount. And it is not one instance or two instances. We have found more than one or two instances. So there is a matter of incipient weakness. And when we inquired, we found that he was doing very huge amount of share transactions. So for the purpose of satisfying his margin of share requirements, he was issuing check. And once he issue the check, it will return. So he will get a breather of around 2 days. Supposing if he is issuing the check on Friday to the broker, he will be getting time after Monday. Monday, he will be withdrawing the check or he will be remitting the money and he will be taking back the check or the check will be returned. So what happens is that the check leaves, which is given by the bank for the purpose of issuing for the genuine supplies of the customer, is misused for the purpose of circumventing, or the banking channels are misused to defray the requirements or commitments of the particular borrower for some other business which he is conducting, share transaction. So these are all very, very intricate aspects which we have to verify in the transaction audit. So these type of things are also expected to be reported by the auditor in the new LFAR. Now, in respect of other accounts, it says that you have to do a process audit. What is a process audit is that you will have to see the documentation. You will have to see how the TODs are sanctioned. You will have to see how the manning of that particular branch. Supposing that if you have got a branch with a foreign exchange portfolio, if I am a foreign exchange dealer or the branch is a foreign exchange branch, if your particular foreign exchange department does not have an experienced foreign exchange handling person, then it is a matter of concern because the process will not be correct. There will be a lot of documentation issue in respect of that particular handling of that particular portfolio. Credit manager. The credit manager has to have a inch of the credit portfolio, working capital management, working capital appraisal. So the credit manager should be a person who is of having competent knowledge in the credit department. So if you find that the process in respect of other accounts, you have to go by the process. So process includes not only the verification of the accounts, it also go beyond the verification of the accounts as per the IRAC norms, receipt of stock statements, whether blank stock statements are obtained and kept for the purpose of satisfying the auditors. There are a lot of cases where stock statements should not have been submitted for more than 4 months. When you go there and for the purpose of audit, they will immediately take out a blank stock statement and give you that this is submitted by the borrower. If blank stock statements are signed and sealed and kept along with the documents, it is not a document at all. Various courts have said that any blank document obtained at the time of issuing or obtained at the time of sanctioning the loan is not a document for the purpose of enforcement. It has been very clearly said by various courts, which means that if the stock statement is given at that point of time, it is not a good stock statement or it is not a genuine stock statement. So there again, you have to verify the process which is being conducted in the branch. If the bank is obtaining blank documents as a part of your documents to satisfy the requirements of monitoring and review, then it is a matter of regulatory concern and it is to be reported. The same is the case with your monitoring. Supposing there is an observation in the stock audit report, there is an observation given by the internal auditors, or there is a deterioration in the value or a deterioration in the rating of the branch. So when we conduct an audit of the branch, internal inspection team which is conducting the audit of the branch will be giving a rating. The rating will be according to the bank policy. So when the internal audit inspections are there, you will find that there is a rating given by the internal auditors. If the internal audit rating is coming down, which means that there is a process flaw, there is a flaw in the conduct of the branch as a whole. So in respect of those accounts which are not directly connected to the benchmark accounts, you will have to go through the process and you will have to find out what are the incipient weaknesses in respect of the conduct of the accounts through the process way. Say, take the case of your master updates. If the master updations are not done properly, and if the master is giving you a wrong information in respect of charging of interest or in respect of even classification of the advances, you all know that the master determines the classification of the advances The master determines the interest application. So if the master is not paid properly, it is a process law. So you have to verify the sanction with the master. Master is the master created at the time of sanction of the loan in the computer system. So you have to go to the computer system, and in large accounts, you will have to verify whether the master is updated. If the master is wrong, which means that your entire system is going to be wrong. Your process is going to be wrong. And there is also a specific question in the LFAR which says that you have to see whether the master updations are properly done at the branch level or not. So we have to be very careful in going into the audit this time, because the LFAR is very specific about what is the mode of, or this what is the method to be adopted in respect of verification of advances is very clearly mentioned in the LFAR itself. Now coming to the regulatory package. The most intricate aspect of the regulatory package is that in respect of regulatory package 1, it says that the MSMEs which are enjoying a limit up to 25 crores of rupees, if it is a standard account as on 28th February, and if it is registered with GST, it is already told by Dhananjay Saab, it says that it is expected, or it can get an additional facility of 10% of the total fund-based and non-fund-based limit without any additional collateral, which means that the working capital easing out to the MSMEs was given. Now, I will come to a pertinent question where if the regulatory package loans, which is additionally enhanced or which is additionally given or which is sanctioned afresh as a working capital loan, if it is utilized for the purpose of regularization of a term loan, which is otherwise non-performing or which is otherwise delinquent or which is totally irregular, whether it is a matter of concern for the purpose of classification as NPA or not. So if a new loan is sanctioned, if a new loan is sanctioned for the purpose of your regularization of the existing delinquent loan, then it is a matter of regulatory concern. You are not, it is a matter of evergreening. You are not allowed to sanction a new loan, or you are not allowed to utilize the new loan proceeds for the purpose of regularization of a non-performing account, which means that it is going to be a process of evergreening. So you have to be very careful in this particular year that whether the additional facilities which has been given through the regulatory package, or whether the regulatory package loans which has been enhanced or which has been additionally given to the borrower is utilized for the purpose of regularizing any irregular account, regularizing any non-performing account, to see that the non-performing status is upgraded. That is very, very important. So in that particular case, if it is done so, it is a matter of regulatory concern and reporting by the audit. So this is another value addition which I can give you. Now coming to the LFAR again, it is coming very, very serious, and it is pinning the responsibility on the auditor. The auditor cannot escape the responsibility of verification, and auditor also here in the LFAR is committing himself. He is committing himself that what is the account that I have verified. The table which is given in LFAR part 5 is giving you, or it is asking you to give the details of the accounts that you have verified. Now, the first portion, what we have discussed is that we should be able to identify those accounts which are coming under the benchmark. So once it is coming under the benchmark, then we will have to select those accounts for the purpose of individual verification. When it is selected for the individual verification, it means that you will have to report those accounts as a matter of fact for the purpose of completing the LFAR formality in this particular table in the LFAR. Supposing that I have got 7 accounts to be verified intricately, or the transaction audit of 7 accounts are required as per the benchmark requirements. So the benchmark requirement is 10 crores or 10%. I have already told you. If you select that in the particular branch, there are around 7 accounts which comes under the benchmark, you have to do a transaction. When you do the transaction audit, after doing the transaction audit, here you have to report. In this particular table, you have to write what is the account number, what is the name of the account, what is the funded balance at the year end, what is the non-funded balance at the year end, what is the total fund-based and non-fund-based. Now, the important aspect which has to be critically analyzed and understood at this point of time is that this table makes the auditor committed himself about what are the accounts he has verified. So he is committing himself. You are committing yourself in the LFAR that I have verified number 1, 2, 3, 4 or 7 accounts which are coming under the benchmark. So now coming from the other angle, once you have committed that you have already verified these accounts, what does it allude? What does it mean? It means that you are taking the responsibility of those accounts. So the responsibility levels are being fixed by yourself. So supposing if you are not going to report here, They will say that you have not selected all the accounts. They will say that you have not done due diligence work. So, supposing 7 accounts are to be taken as benchmark for the purpose of transaction verification, and if all the 7 accounts are being reported here meticulously with account number, account name, and all these things, it means that you are committing yourself that you are already verifying these accounts. And if you are not verifying also, it is a matter of due diligence. It will say that you have not included here, which means that you have not verified. So what I would request all the auditors is that when we go for the audit, we should be able to be very careful in respect of selecting the accounts which are for individual intricate verification. Point number 1. 2 is that you will have to list out those accounts which are for intricate verification. 3 is that we will have to conduct a transaction audit in respect of those individual accounts. 4 is that you will have to give a clear report about which are all the accounts which you have verified in this particular table. And also further, if you go down the table, it asks you what is the total amount of advances that you have verified. And it also asks you what is the total amount of the branch advance and the percentage of the branch advance covered by you. Now tell me, is it not for the purpose of consolidation at the bank as a whole, and tell that the branch auditors totally, the 3,000 branches are there. Out of that, I have selected 2,700 branches. All the 2,700 branches put together has verified only X percentage of my advances. So why can't we increase the benchmark of 20 crores of branch audit limit to 100 crores? So that another few of chartered accountants or a group of chartered accountants will lose the branch audit. So this is very, very important. So what I would suggest is that you should be able to increase the percentage of verification in this table. The more you increase the percentage of verification in this table, it is not necessarily that you should be only sticking on to the benchmark. You can go to the other potential NP accounts, you can verify so many other accounts, and you can verify whatever account you have listed accounts examined for audit. It does not, particularly, specifically, as per requirement, you have to select those accounts which are coming above the benchmark. It need not necessarily that it is confined to that particular account. You can verify any other account for the purpose of audit, and you can include in this, which means that if you are able to increase the overall percentage of your verification, that will be only giving a value addition to the process of audit. And I would request all the auditors to at least cover 75% of the branch verification, 75% of the advances. If you take around 7 accounts, 8 accounts, which is coming under the benchmark, it will cover around 40 to 45% or at least 60% of the advances. Once that is covered, another 20% of the advances you have to select, and you have to include it here so that at least 75% of the branch advances are verified by you. Once you verify 75% of the branch advances, it is a reasonable way in which you will be able to present yourself to say that you have made a you have done a due diligence in respect of verification and audit of that particular branch. Now, this particular table has to be filled by the auditor. So the filling of this particular table has got 2 edges. It is a double-edged sword. So if you are going to fill it, you are assuming responsibility. If you are not going to fill it, immediately the core will be selecting those accounts which are to be verified. And if you are not verifying, that will tell upon the due diligence. Now the major aspect is in respect of your quick mortality. What is a quick mortality account? LFAR, this is newly added. Whatever is newly added in the LFAR is given in red. So whatever is otherwise in black is the old LFAR form. So this quick mortality account has been added in 2021. What does it mean? Quick mortality account is an account where the account is becoming an NPA within a period of 12 months of its sanction. That is 1 year of its sanction. So if an account is sanctioned in December 1st, 2019, and if it is going to be NPA by December 2020 December, then it is a quick mortality. So any account which is going to be or which is an NPA, which is in a period of 1 year from its original sanction, then it is a quick mortality. Here again, the RBI very clearly requires that the auditor has to verify and he has to give the account name, the account balance, and also the balance at the year end, and also the account number. Which means that you are assuming responsibility, you are verifying that particular account, and you are also supposed to give the details of the particular account in numbers, in discrete numbers, which assumes or which involves that you are accepting the responsibility of having verified. Now the question is that if you have not gone through any quick mortality account, or if you have not reported any quick mortality account, what we will usually do is that we will write there that we have not come across any quick mortality. It is not sufficient, because quick mortality accounts can be easily found out from the head office level. It can be easily found out by the central statutory auditors. It can be easily found out by the Reserve Bank auditors. So in that particular case, if there is an account which is having a quick mortality and if it is not reported by the auditor, then it is a matter of concern. Very, very simply, what you have to do is that you will have to only go by the date of sanction versus date of NPA. You go to the NPA asset classification statement and take out the account which is sanctioned, that is a date of sanction and date of NPA. If there is a difference of the date, the time gap between the date of sanction of the account and date of NPA is less than 1 year, it is a quick mortality account. Very easily you will be able to find out. You can even put the asset classification statement into an Excel, and the two field you have to select. One is the date of classification, date of NPA and date of sanction. So if you put date of sanction, date of NPA, in the third column you put the difference. If the difference in number of days is less than 365, it is a quick mortality account. So once it is a quick mortality account, you will have to report into the LFR. And once it is reported in the LFR, you have to give the account name, account number, and the account balance as on 31st March. Now again, the most important in respect of this is the credit rating. So the credit rating is required to be fed into the system. What is happening is that the accounts which are large in nature or accounts which are above a benchmark, take the case of accounts which are above 5 crores. Majority of the cases, we will say that 5 crores is the benchmark for creating a large account or a small account. That is only a practical guideline I can give you, but the bank policy may change. Or you can go to the bank closing circulars to see whether which is correct. That is what is the large advances criteria of selection of a large advance. So here what it is saying is that you will have to find out whether the credit rating has been properly fed into the system or not. Whether the credit rating has been properly fed into the system. What does it mean? It means that the credit rating accepted or credit rating obtained from outside has to be fed into the system. If it is not fed into the system, it is a matter of serious regulatory concern and it has to be reported. So what is more important to find out is that in the COVID pandemic period, most of the credit rating would not have been obtained, or the credit rating should not have been or would not have been done. That is a matter of regulatory concern. If the credit rating is required to be done in that particular account and the credit rating is not done, then it is a matter of fact to be reported here. And if it is done, you have to see whether it is properly reported or properly fed into the master or not. If it is not properly fed into the master, what will happen is that in many of the cases, the interest rate of the borrower and the credit rating has some linkage. Supposing that I am in a AAA plus account, my interest rate will be lesser than a BB plus account. So the interest rate and the credit rating has got a linkage. So if I am not going to feed this particular credit rating into the master properly, what will happen is that we will be failing in the duty of analyzing it very in principle, or the crux of the matter is not properly analyzed. So credit rating has to be first obtained. Two is that the time lag between the two credit rating has to be verified. The time lag between the two credit rating is 1 year. So every year the credit rating has to be updated. So if the credit rating is not obtained for more than 3 years, it is a credit rating which is obtained beyond 3 years. So it is not an updated credit rating. That is also a matter of reporting. Now the thing is that the credit rating is deteriorated. That is a matter of concern. What is happening is that in the earlier credit rating, the borrower has got AAA. Now in this present credit rating, latest credit rating, that has been downgraded to BB plus, which means that there is a downgradation in the credit rating. That is also a matter of audit concern. So they have asked you to only report about whether the credit rating is properly updated in the system. But for the purpose of further validation and regulatory requirement, what is to be seen is that whether your credit rating is taken or not for all the accounts where credit rating is to be taken. That is, independent credit rating is to be taken for large accounts. Point number 1. Point number 2 is that if the credit rating is taken, whether the credit rating is obtained or not. 3 is that the obtained credit rating is properly updated to the master or not. Point number 4. Point number 5 is that you will have to see whether there is any deterioration in the credit rating. If there is any deterioration in the credit rating, then it is a matter of serious concern. You will have to find out what are the points for which it has been deteriorated, whether the market conditions are more, whether the working capital management of the particular borrower is more, or the succession planning of the business is not correct. So credit rating covers almost every scientific aspects of the business, both qualitative and quantitative. So if there is a deterioration in the value, deterioration in the credit rating, then it is a matter of concern by the auditor. So that is what is expected to be done in this particular column. Now, in respect of the next point, what is stated is that the review and renewal mechanism. What is being done in the bank is that every time when the review or renewal is taking place, it will be always taken for granted that if the comprehensive renew is not being taken place, they will do or they will resort to a short review or a limited review or an ad hoc review. What is review? As already been told by Dhananjay Saab, what he told is that the financial statements are to be obtained afresh, and the latest audited financial statements are to be obtained, and we have to do a credit appraisal every year. In respect of a CC account, in respect of an OD account, you will have to make an appraisal of the credit limit every year, and you have to make a fresh sanction or fresh renewal, and renewal sanction has to be given. So when the renewal and sanction is given, it is a process of comprehensive review of the entire financial statements, which is obtained afresh. When the financial statements are not obtained afresh, what will happen is that immediately the bank will resort to a methodology called limited review. What is limited review is that they will be doing it with available financials, available statements, available financial statements, available documents. So when it is being done with available documents, it is a matter of limited review. So it is not a matter of comprehensive review. In that particular case, the auditor is expected to verify and report whether this is resorted for the purpose of continuously rolling over the account by limited review and ad hoc review. Very important question has been asked in the LFAR that what in your opinion the major shortcomings in monitoring, which means that if the review, periodic review of advances is being used as a rollover of that particular facility. And if you go to the IRAC norm, it says that if the account is not renewed for more than 6 months, then it is a matter of consent to be classified as an NPA. So in this particular paragraph, what is being asked is that you will have to go more beyond the IRAC norms and find out whether the limited review and the review process is being done properly and whether there is any flaw or whether there is any serious deficiency in the review process or not. Now the DP is again drawing power. So how do you calculate the drawing power? Now if you go to the IRAC norm, you will find that the drawing power is of high importance. The significance of drawing power comes from the IRAC norms. It says that the limit is reported to be or limit is classified to be out of order if the limit is operated beyond the sanction or the drawing power whichever is less. Supposing I have got a sanction of 10 crores of rupees and my drawing power is only 7 crores, my limit is only 7 crores. I cannot draw up to 10 crores. So if the limit is operated beyond 7 crores for more than 90 days, then it is an out of order account. So the drawing power is very, very important. So what the LFAR, new LFAR says is that whether the drawing power has been properly computed or not. So here we have to be very, very careful. There are around 5 points which is to be looked at the drawing power. One is that how do you calculate the drawing power? Before that, we should understand what is drawing power. Drawing power is the power of drawing available as per the primary security available from time to time. What is primary security? Your stock, debtors, or anything can be your work in progress. Everything can be primary security. So, if you have given primary security or if you have analyzed the working capital on the basis of the stock and debtors, the stock and debtors statement has to be filed by the borrower on a monthly basis. And on the monthly basis, when the drawing power also has to be calculated. So, you calculate the drawing power on a monthly basis, and also you feed the particular drawing power into the master, and then you will do the exercise of calculation of the drawing. So what the auditor is expected to do is that whether the drawing power is calculated properly or not. If it is not calculated properly, it is a matter of concern. How do you calculate? The drawing power is calculated on the basis of the latest stock statement, latest debtor statement. Then you will be reducing from the latest stock statement whatever is the non-moving or the non-saleable or obsolete item. So the non-moving and obsolete item has to be removed, and you also have to remove the sundry creditors and all the advances received against the particular stock, and you will come at the net available stock. The net available stock has to be again reduced by the margin to find out what is the drawing power. So the drawing power calculation is to be aligned with the norms prescribed by the Reserve Bank of India and in the banking parlance, and you have to calculate the drawing power, point number 1. Point number 2 is that the drawing power has to be set into the system. It has to be properly fed into the master of the system. 3 is that in the case of consortium advances and in the case of multiple banking arrangement, the drawing power may be of the entire borrower as a whole. Supposing I am a big borrower where I have got around 50 branches across the country and I am banking with more than 4 banks. All the 4 banks in consortium or through multiple banking arrangement is giving me the finance. And my stock and debtors are being pledged with all the banks. In that particular case, what is more important is that the drawing power also is to be calculated on the basis of the share of the bank towards the entire loan portfolio of the borrower. Supposing a big borrower has 100 crores of loan divided into 25 crores of 4 banks, which means that every bank holds 25% of the share of the total share of the 25% of the total share of the consortium, which means that the drawing power as per the stock calculation, as per the availability of stock, you should also be calculating only 25% of the share. You will not be able to calculate 100% of the share. So what is more important is that whenever you are calculating the drawing power, you have to see whether the stock statements are obtained on time. 2 is that whether the drawing power is calculated properly. 3 is that whether the drawing power is fed into the system properly. 4 is that in respect of consortium accounts and multiple banking arrangements, only your share of drawing power is considered for the purpose of your account. Now, it is in the case of your stock audit. More important is that in the case of accounts which are above 5 crores of exposure, what is required by the Reserve Bank of India and as per the bank policy by and large. By and large. I use the word by and large because you have to identify what is the policy of the bank for the purpose of conducting stock audit. So stock audit is to be conducted and the stock audit report. Earlier the question was not there. This year the question was ending there. Cases where stock audit was required to be conducted was not conducted. That was the question earlier. Now it says that where stock audit was conducted and no action was taken against adverse switches. This is a new addition, which means that the auditor is expected to go through the stock audit report. And through the stock audit report, the auditor also has to find out whether there is an observation given by the stock auditor. If the observation given by the stock auditor is not addressed properly, take the case of a stock audit report, which says that the sundry creditors are there in the particular accounts, which has not been considered for the purpose of submission of stock statement. Which means as a sundry creditors have to be considered. I have done a stock audit of a automobile company where the automobile company by and large will receive advances from customers. So the advance from customers is a liability. So advance from customers is a liability against the stock. It is totally against the stock only. Tomorrow, if I'm going to sell this particular stock, I'll be receiving the money only less of the advance received. So that is going to be, if that is going to be again funded by the bank, what will happen? Supposing I have got advance to the extent of around 5 crores of rupees. So tomorrow my sales is going to happen. My cash flow will be restricted or reduced to the extent of these 5 crores. So whenever there is an advance from customers, which would have been reported in the stock audit report that the advance from customers against the sale or against the stock which is going to be delivered to him is not factored at the time of considering or filing the stock statement or not factored at the time of calculating the drawing power, it is a serious flaw. So we have to analyze those aspects in those lines and find out whether the advance from customers in respect of stock has been properly dealt with while calculating the drawing power. It may be an observation in the stock audit. So whether the stock audit report observations are addressed by the branch properly or not. Take the case of insurance. Stock audit report would say that the insurance has not been taken or the insurance is not sufficient. Or the stock audit report will say that the work in progress cannot be valued. Or we have come across a particular cases where the stock statement was submitted with a huge amount of work in progress. Work in progress. Work in progress. If you look at the stock statement, you will have material or finished goods are very less. Raw material is very less. But work in progress is huge. Work in progress is more than proportionate to the finished goods as well as the raw material. And the borrower was submitting stock statement time and again. When we went to the stock audit report, we found that the stock auditor very critically has commended that considering the production flow, of the particular borrower, you cannot have work in progress to the extent of X, which has been reported in the stock statement. Find out the criticality. Supposing that my production capacity is only 50 tons. If the production capacity is 50 tons, how can I have a working capital, work in progress of 100 tons? So these are all the intricate points which would have been dealt in the stock audit report. If it is not considered at the branch level, these are all the points which as an auditor at the year end we also should consider. So what is being asked in this particular paragraph in the LFAR is that whether the stock audit report observations are properly considered or not. Now again, the substantial value, the deterioration of the security, very important from the COVID pandemic, because what is being asked is that if you feel that there is a substantial erosion in the value of the security, either your collateral security or primary security. But time and again, we see that the COVID pandemic has made a lot of business models, lot of business proposals, and many businesses have totally collapsed. In those businesses which is totally collapsed, if you find that there is a stock which is an obsolete stock or which cannot be taken for any purpose, and if the stock statement is also submitted, you have to see whether there is any deterioration in the value of the stock or not. If the deterioration in the value of the stock is there, and if it is substantial that it should be reported, it is a matter of serious concern and it has to be reported. So LFAR has included NU that if the substantial deterioration in the value of the security. Now I would like to drag you to the IRAC norm. What the IRAC norm says that if you have heard Dhananjay Saab, Dhananjay said that if the deterioration in the value of security is more than 50%, you have to directly downgrade the account into doubtful category. The account needs not pass through the substandard category and keep it there for 1 year. So you can directly go to the downgrade category of doubtful loan. And if the account deteriorates the value of the security is more than 10%, it is a loss. So that is as per the IRAC norms. But it is not here. The LFAR does not consider reversal for the IRAC norms. It says that you will have to see whether the account deterioration is substantial or the value of the security or security value deterioration is substantial. Even if it is 40%, even if the auditor finds that this particular account deterioration in the value of security is huge, that it is going to impact the bank as a lender in the future, is also a matter to be reported. So the deterioration in the value of the security has to be seen comprehensively from the pandemic angle, and you will be able to find out whether there is a matter to be reported here or not. Now coming to the red flagged accounts. So in every banking system, it requires that there should be an early warning signal in the banking parlance. Early warning signal includes any potential NPA, any account where the incipient weaknesses are being reflected, any account where the TODs are not regularized on time, any account where the installments are not paid on time, any account which is asking for frequent TODs, any account which is not renewed for more than 6 months. These are all accounts which are coming under the early warning signal. In the early warning signal, again it says that there are certain potential fraud accounts. Potential fraud is overstatement of stock statement or giving false financial statements or overstatement of debtor statement or falsification of any documents given to the branch. All these things are kite flying operations of the check. All these things are considered to be potential fraud. So now red flagging is in respect of those accounts where potential frauds are detected. If you find that the stock statement of the particular borrower is much above than what is being stated as per the stock audit report, it is a matter of serious concern because it is a potential fraud because the stock statement is overstated. So here the red flagging of that particular account has to be done because there is an early warning signal in respect of a potential fraud. If you go to the LFAR, there are around 31 instances which has been given in the LFAR which can be termed as a potential fraud. We will discuss about that later if the time permits. So it says that 31 instances we have to be carefully looking at from the fraud angle. And if there is a symptom of those potential fraud, then it is a matter of serious regulatory concern to classify this account as a red flag. So here what is required is that you will have to see what is the policy and the procedure of the bank to make a classification or to make an account as red flag account or not. So the red flagged account is not peculiarly the early warning signal account. It goes further one step ahead, saying that the potential risk of the account terming to be a fraud account is also to be considered for the purpose of red flag. So early warning signal accounts are normal accounts where there is no potential risk of fraud. But red flagged accounts are accounts which are having an early warning signal plus a potential fraud. So there you have to see the procedure, and this is a new provision, this is new question which has been asked in the LFAR to be reported by the audit. Now, the very important hitch in the LFAR is that the comment on the adverse which is considered significant in top 5 large standard accounts and which need the management's attention. Very important. What is required is that the auditor has to take into account, or auditor has to select 5 large value standard accounts. So it is not non-performing accounts. You have to select 5 large standard accounts. And in the 5 large standard accounts, you will have to make a significant adverse feature, which you consider as significant. So your judgment is being again questioned. You have to apply your wisdom, and you have to apply your wisdom, and you have to also see whether that is significant for the purpose of your verification or not. So if it is going to be significant that you have to report that particular account or the adverse feature, or I would say that it is in the whatever the lighter way, you have been asked to find out 5 bad points of a good person. So 5 large accounts you have to select, and you will have to find out what are the bad adverse features which is significant for the purpose. Need not necessarily that it is a non-performing. So this is very important. Now it says about comment. The comment part is dragging you and requiring you to give a report. You cannot just like that escape from commenting, which means that you cannot just like that say that I don't find any adverse features. That is going to be more dangerous. I would say that if you are going to report here that I have verified 5 large accounts and there is no, that is a general way of reporting. General way of reporting in the LFAR is that we have verified 5 large accounts and there is no significant adverse features. Very dangerous. If you are going to do that, and if any of the 5 large standard accounts are going to be having any incipient weakness, or it is turning to be NPA within a period of 3 months, or if it is having a fraud, then it is a matter of regulatory concern. Then it is a matter of due diligence from your side. And again, it says that you cannot just like that say that I have verified XYZ account. It says that you have to comment. You have to comment, which means that a descriptive report is expected by you. This is going to be a very responsible job of the auditor. In the first paragraph, I told you the table is being given to discreetly give the account name, account number, etc. There they did not ask you to comment. Here you are asked to comment. Comment means you have to give observation. You have to give a report. So your reporting is to be elaborated. Your reporting has to be discreet, and your reporting has to be commendative to see that what are the points which you would like to drive home to the central statutory auditors as well as to the RBI. Now, manual intervention. It says that if you go to the slide of our managers app, it says that there is a circular which has been given to the banking system, which says that from June 30th, 2021, there should not be any manual intervention in respect of drawing the asset classifications. For the last 4 or 5 years, we are hearing the same story from the same banks, stating that, sir, you don't have to do anything because all the system generated IRAC norms and the classification statements are with you. You have to just sign and go. But then what is our job? Our job is not limited to just signature. Our job is to verify whether the system generated IRAC norms are correct or not. How will you verify? We have got a lot of methods of verification, whether there is any flaw or whether there is any inconsistency with the IRAC norms. How do you verify is that you do not know schematically whether the income asset classification statements are properly taken or not. What we will do is that we will use the methodology of auditing through the computer, auditing with the computer, or auditing around the computer. Now, in the case of auditing around the computer, in respect of identifying the NPA accounts, which are all the problems in the NPA accounts which are taken through system or system generated asset classification statements. If you take the auditing through the auditing around the computer, you take 3 outputs. 3 outputs. One output is that you take the NPA accounts as on 31st March 2021. That is already given to you for the purpose of your signature. Now you take the asset classification statement as on December 31st. You take the asset classification statement in any intermediary dates between December 31st and March 31st. And also one more you can take during September or before the COVID period also you can take. Because before COVID period is more important because you have got to have a lot of recognition, the classification to be done as per the status of the account as on 1st March 2020. Pre-COVID period. Pre-COVID period ends on 1st March 2020. So as on 28th February 2020, what was the status of the account determined a lot of other factors for the purpose of your COVID package. So you can draw the asset classification statement as on 28th February also. You can ask for the asset classification report as on 28th February. So if you do an auditing around the computer and if you put all these 4 into an Excel sheet, you will find that there are certain accounts which are upgraded or which are downgraded. How do you identify? If an account is finding a place in the earlier statement and does not find a place in the later statement, it means that it is upgraded. It is taken out of the non-performing asset category, which means that if I find X account as a non-performing asset in December statement, and if I don't find that X account as an NP account as of March, it means that it is upgraded. So this upgraded account has to be gone in deep. How the upgradation has happened, whether the entire overdues have been regularized, what is the regularization process, whether there is any evergreening process, whether the genuine credit has come through the account. This is one way of looking at it. Take the case of your SMA 0, SMA 1 and SMA 2. The reports are to be generated from the system. If you take SMA 0, it shows that the delinquency is between 0 to 31 days and 31 to 60, 0 to 30 days. 31 to 60 days is SMA 2, SMA 1 and 61 to 90 days is SMA 2. So you all know that particular SMA 0, SMA 1 and SMA 2. So if you look at a particular account, if there is no regularization happening for an account which is in SMA 0 for more than 1 month, what will happen? It will automatically slip to an SMA 1 account. And the third month, it will be in SMA 2 category, which is called a natural migration. So the natural migration has to happen. So if the natural migration is not happening, it means that it is upgraded. So what you have to do is that if you do an auditing around the computer of drawing the SMA 1, SMA 0, SMA 1 and SMA 2 account for the month of December, January, February and March, you will find that whatever is being finding a place in December as SMA 0 has to invariably find a place in SMA 1 in January. And whatever finding a place in SMA 1 in January has to find a place in SMA 2 in February. And whatever finding in SMA 2 in February has to find a place in SMA 1 in February has to find a place in SMA 2 in March. Because there is a natural migration process which is happening. If there is any inconsistency, if you find out that the natural migration is not properly coming out, the account would have been regularized, or the account would have been upgraded, or the account would have been properly eliminated. What is the elimination process? If you find that the weakness of that particular account has not been regularized through proper channel, or without evergreening, or without enhancement of the limit, or without sanction of the new loan, or if it is not coming out of the genuine credit, then it is a matter of serious concern. Or if nothing is there, and if this is going to be happening, it means that there is a manual intervention in the system. So these are all the inferences we can make by auditing through the auditing around the computer. Auditing through the computer, the exceptional reports available within the system itself. There are a lot of reports available in the system. If you have seen that there is a parameter change report. Parameter change report, if you go, you find that the master parameter has been changed. What you call your initial holiday is changed, or your EMI is changed. In that particular case, you can very well understand through this, through the system, through the schematics of the system, through the exception report generated in the system, you can find that there is a manual. So, and again, as has been told earlier, security value, the updation of the security value, the updation of the drawing power, updation of the interest rate, all these things are to be manually done dynamically at the time of sanction, at the time of receipt of stock statement, and at the time of year end. So in the case of security, as has been rightly told by again the previous speaker, Dhananjay Saab, security value in respect of a depreciable asset. If a lorry is purchased or a car is purchased, the original value at the time it is purchased or the sanction of the loan is be given as a value of the security. Now, if you are not going to depreciate it, or if you are not going to deteriorate the value according to the obsolescence, then it is a matter of serious concern in respect of security value. And if the account tends to be NPA after 4 years, and if it is a doubtful asset, your secured and unsecured portion determines the quantum of provision. So that is going to be very serious. So these type of intricate aspects which can come into the manual interventions of the asset classification statement has to be seen by the auditor. So we have to very seriously verify whether there is any manual intervention or whether there is any discrepancy in the asset classification statement which has been generated, which is very, very important. Now coming to the most important aspect is that again, the auditor is dragged into the responsibility. It says that you have to intricately, individually verify those accounts which are upgraded or downgraded, which is more than 10 crores of rupees in individual value. Which means that one borrower account, can I go for another 10 minutes? Chairman?
Sir, please, go ahead, sir.
10 minutes, sir? No problem?
Please, sir, no problem, sir.
Okay. I want to see your face. You are all hiding yourself. What happens is that in the virtual meeting, the major aspect is that after some time, if no faces are coming, we will feel that we are speaking monologue. We are only liking a newsreader, as Dhananjay has said. So I have seen only one face, Mr. Sundar, but he is also missing now. So all the videos are off. Anyway. Now coming to the individual accounts which are more than 10 crores are to be specifically verified and reported by the auditor. So it drags a lot of responsibility to the auditors. So this time LFIR is not an easy job. It is an onerous task on the LFIR. For the purpose of completing the LFIR, you will not be able to just like that shut your file and come back. You will have to do a very, very meticulous job in filling the LFIR. So here in this particular paragraph, what is asked is that you have to identify those accounts which are upgraded or downgraded above 10 crores of rupees individually. So above 10 crores of rupees individually, you have to upgrade or downgrade. So how will you identify? You are certifying an NPA statement. An NPA movement statement is certified by you, which gives you what is the opening balance of NPA, number of accounts and total amount, and what is the upgradation which has been done during the period, and what is the downgradation done. That is what is classification as NPA during the period, and what is upgraded during the period, and closing balance of NPA. This is certified by you. This is the basis on which your total gross NPA, net NPA percentage is calculated for the bank as a whole. So when the certificate is given, you find that there are around 5 accounts which is upgraded and 5 accounts which are downgraded, or 50 accounts upgraded and 5 accounts downgraded. Whatever it is, you will have to go into the individual accounts. If it is of the value of more than 10 crores, you will have to see whether it has been done according to IRAC norms or not. So list those accounts, and also you have to see whether it is upgraded or downgraded as per the asset classification norms prescribed by the Reserve Bank of India or not. Very intricate, specific, discrete question posed onto the auditors. So you will not be able to run away from the responsibility here. You will have to report here as to, you have to select those accounts which are downgraded or upgraded about 10 crores of rupees. Then you have to go to the IRAC norms. If it is not following the IRAC norms, immediately you will have to report. You cannot. Next thing is that the income recognition and other classification. You have to comment on all these things. If you are not going to comment, it is going to be a very serious concern. Now coming to the major aspect is your non-fund based. In respect of non-fund based advances, you find that the two aspects is in respect of your VG as well as your LC. So in respect of your LC, what is happening is that the LC will be devolved. Earlier, if you look at the LC portion was asked in the LFIR whether there was any invoking or devolvement of the LC as on the year end, that is 31st March. Now it is not like that. It is being asked that whether there is any LC devolved during the entire year. So the year, throughout the year, if you find that if any LC is devolved, then it is a matter of serious concern. So you have to go through the non-fund based advances, and you have to see whether there is any LC devolved during the entire year of 2020-21, and you have to find out whether there is any requirement of provision, and if requirement of provision is there, you have to drag that and you have to do an MOC also. So what is more important is that the incipient weakness should not be confined to the year-end process. We should also be going through the entire year as a whole. So any LC devolvement in the year as a whole also has to be identified, and you will have to take out whether the devolvement is given in the table. Now coming to the case of your guarantee. In the case of your guarantee, it says that any ECGC guarantee or any guarantee which has been rejected by the ECGC, you will have to go into the reason for the rejection, and if any provision requirement is there, you have to pass MOC. LFAR in 4 places, it says that the auditor has to pass MOC. MOC has to be passed by the auditor. So earlier it was not specific in the LFAR that you should pass MOC. LFAR was only asking you the functional areas representing or reporting of the representation of the functional areas. Now it is not confined to that. It is asking you to report. It is asking you to comment. It is asking you to give in the tabular format what is the account number, account name, account balance, etc. And it is also asking you to pass MOC. So LFAR is becoming more discreet, and it is forcing the auditors to do this. It is asking the auditors to do this. And again, the development of the LC has to be seen in various angles. One is that it asks whether the interchangeability of limits has been exercised by the branch or not. Time and again, what we have seen is that when a limit is sanctioned, we will have around 50, we will have around 5 limits sanctioned together in an account. But means that CC account will be 100 crores, term loan account 1 will be 25 crores, 2 will be another 25 crores. Like that, 2-3 term loans account will be there. Totally, your fund-based exposure will be 300 crores. And below that, it will say that bank guarantee limit is 25 crores and your LC limit is 50 crores, which means that your total fund-based plus non-fund-based limit sanction is 375 crores. So all your documentation, everything will be made for 375 crores. And in the sanction itself, there will be a line stating that in the eventuality, the bank may exercise the option of interchangeability between the limits. That was causing a lot of loss to the banking industry as a whole, because the interchangeability of limits between fund-based and non-fund-based, or between non-fund-based to fund-based, was creating a lot of damage to the banking industry as a whole. So now LFA has come out with a question stating that whether the interchangeability of limit has been made during the year and subsequent development has taken. Very important. Supposing I have got an NFP limit of 50 crores, which is converted into a fund-based limit of interchanged and increased to the CC account. And when development comes, I am going to debit that account. So it is within the limit only. So that is being practiced by the bankers, because your interchangeability was taken as a plank for circumventing the NPA norms and inviting huge loss to the banking industry. That was very, very important, taken by the LFR. Now, in the case of deposits, and I would like to only tell about the sundry assets, sundry deposits and stationery. In respect of sundry assets, you all know that the suspense account and other things has to be reported. It says that wherever you find that the suspense accounts cannot be recovered, you have to pass an MOC. Again, MOC is required to be passed by the auditor. And again, the last point is that in respect of your security stationery. Security stationery, it says that you have to verify the security stationery. I would like to add 2 points in the security stationery. The practical scenario in respect of this year is that the security stationery will be belonging to the erstwhile old bank or the demerged bank. So the demerged bank security stationery, supposing that you are going to Corporation Bank branch, which is now a Union Bank. So it is, if you find that there is a fixed deposit receipt printed in the name of Corporation Bank, if you find that there is a computer generated fixed deposit receipts in the name of Corporation Bank, DD in the name of Corporation Bank, all these stationery are very vulnerable from the angle of fraud. All these stationery are going to be very, very serious for the purpose of fraud, because we have seen that more than 30% of the total fraud in the banking industry has happened by only mishandling the security stationery. Security stationery includes your FD receipts. Security stationery includes your checks, demand drafts. All these things are called as security stationery. So the security stationery, which are redundant or which are no more in use, which are in the name of the earlier bank, can be misused. We have come out with a very clear case in one bank where a fixed deposit was coming for renewal, or the fixed deposit was coming for encashment. It is coming for encashment from the SEBI. SEBI has asked one particular bank for encashment of fixed deposit after a period of around 4 years. Then only it is found by the bank that this particular fixed deposit itself is a fraud, because the stationery was forged by one of the staff and it was used for the purpose of giving as a security to the SEBI for the purpose of share trading. And the share trading collapsed, and this person, the SEBI has asked for the fixed deposit receipt to be encashed. At that point of time, only the bank came to know, which means that your stationery, security stationery, may create a lot of damage to the bank. Now, in the case of your merger and demerger, if the security stationery of the old bank, that is demerged bank is available at the branch, you should be very carefully verifying that, and you should be reporting immediately to see that it should be either sent to the head office, or it should be cancelled, or it should be destructed. If you are not doing that, it is going to be posing a very serious problem. In fact, I have addressed this particular point to the top management of various banks also. But I don't think how are it be practically possible, because in earlier cases also, when the computer came, the old handwritten stationaries were all taken to be redundant, and it has to be sent back. But no banks or no branches did send it back, and there were a lot of frauds which has happened in respect of those stationaries. So these are all the points, and now I would only say that the LFIR cannot be taken lightly by the auditors this time. And it is again one Nirav Modi question is there. It asks that whether there is any software other than, or whether any software which is not linked to the CPS system. Particular Nirav Modi question, which says that in the case of Nirav Modi incident, we have seen that the SWIFT or the messages which are coming from international operations were not connected to the CPS. That was the root cause for your Nirav Modi fraud. So here the question is asked to the auditor whether the particular software, or whether the branch has got any other system, any other software used which is not linked to the CPS. That is again a technical question which has to be very seriously dealt with by the auditor. Now again, another important question, intricate question is that whether you find out that there is any data integrity issues there. Data integrity issue. What is data integrity? Data integrity is a very, very exhaustive terminology. Data integrity is a qualitative aspect and a quantitative aspect. So we have to be very careful in reporting that. I don't know how auditors are going to complete LFR this time. Now, in respect of fraud, I told you that if time permits, we will go to the intricate 31 aspects which has been given as fraud. In respect of fraud base, it says that falsification of accounts, false representation by the borrower, misappropriation of funds, especially through related party shell company transaction, forgery and fabrication of financial documents like invoices, debtor list, stock statements, trade debtors, etc. So these are all the points which is given in the LFR itself. So when it is printed in the LFR itself, you cannot escape the professional skepticism of verifying those accounts from the fraud act. So this is going to be very, very serious. And again, it says that data integrity. See, it says that procedures to ensure data integrity related to all data. Very, very wide ramification is there. If any MIS is going to be wrong, if any system, if the master updations are not correct, anything which is connected data integrity which is fed into the system is being asked. If there is any process flow, or if there is any issue in respect of the feeding of the data into the system for the purpose of any MIS, integrity of the data is affected. That is a matter of serious concern to be reported by the audit. So these are all the major points I can cover you in 1.5 hours. I think you have been given this particular slide. I think chairman may please circulate this particular slide, and all the red points is indicated as modifications or which has come anew. Now we will just go to the chat box. Can anybody read what is in the chat box?
Question, sir. Question Q&A, sir, not chat box, sir.
Oh, Q&A. Okay.
Sir.
Question. Yeah, sir. If we observe frequent cash withdrawals in CCOD accounts, yes. So, sir, see, frequent cash withdrawals, that is what I told you. You have to align with the business model. The business model of the customer has to be, that is what I told you. Knowledge of the business of the client is further extended to model of the knowledge of the business of the client. Our client is bank. Now you should know the model of the business of the client. That is a branch customer. If he is a retailer, it will be cash deposits and your withdrawal by RTGS or thing. Take the case of a contractor. A typical example. A contractor will be receiving money from the contracting, government, PWD or any other thing, it will be receiving in bulk. So the credit will be all cash, RTGS or bulk. In the case of your withdrawals, you will be taking a lot of cash for the purpose of your wages payment, etc., etc. Take the case of a person who is intermediary supplying fish to the exporter. Typical example. I think Andhra Pradesh, it will be typical. Lot of fish landing centers are there. Whether the procurement will be done for the purpose of exporter and they will be giving the fish to the exporter. In those cases, your fish exporter will be giving RTGS or transfer to the funds to the account. And their bulk credit will come. But in the case of your cash withdrawal, you will have to pay cash to the fisherman. If you look at, there is an exemption in our 40A3 rule. We read with the rule 60D. 40A3 read with the rule 60D. I think it is 4. Says that if it is directly paid to the fisherman, or if it is directly paid to an agriculturist, your 60D 40A3 is exempted. Here, if cash withdrawals are there, again another point is that your 194N is coming into the play. If cash withdrawals are more, you are supposed to attract the TCS provisions. So you are all tightly this. But from the bank audit point of view, if your particular account is selected for benchmark auditing, and if you are going to the transaction audit, if you find that there are a lot of cash withdrawals or even cash deposits, you will have to align it with the business model of that particular borrower. If it is not consistent with the business model and the business profile of the particular borrower, then it is a matter of concern to be reported by the auditor. Now, since all the transactions to be routed through CC account, in proprietary concern, how EMI of housing loan installments shall be paid? Yes, EMI of housing loans can be seen in 2 ways. One is that EMI of housing loan with the same branch, with the same bank, and with an outside bank. Three things are there. What I told you is that if the EMI is paid to another bank, HDFC, and if you find that there is an inconsistency in respect of huge withdrawals beyond commensurate, supposing that you have got a total limit of 10 crores of rupees, and your withdrawal for the EMI is only coming to around 50,000 rupees, it is not a matter of concern. But take the case that you have got a limit of 2 crores of rupees, and 3 lakhs rupees is going to your HDFC bank for purpose of EMI payment of your Benz car. It is a matter of withdrawal. It is a matter of diversion of funds. So you have to use your wisdom. You have to align your wisdom. You have to blend your wisdom and align it in sync with the business model of the customer and the overall magnitude of the operations and magnitude of the limit of the customer for the purpose of verifying the transactions. In the case of gold loans which are renewed after receiving the interest portion only, whether the gold loan can be, very simple question. 2 aspects is to be seen. Dhananjay has very clearly explained this. One is that whether the account was performing asset before. If the account was continuing to be performing asset, and if the critical amount, the bankers will call it as a critical amount. That means that whatever is to be paid for the purpose of taking it out of the NPA is paid, then it cannot be treated as NPA at all. But once it is classified as an NPA, that is what the classical example he has given. 4 installments pending as on December, 2 installments paid as on 31st March, whether you will classify it as an NPA or as on 31st March or not. Because once it is classified as an NPA, then your regularization or upgradation of the NPA has to happen only if all the overdues are settled. So in this particular gold loan case, if the account is not classified as an NPA, and if the critical amount is paid, then it cannot be taken as an NPA. But if it is already classified as an NPA, and if only the critical amount is paid, and if not all the overdues are paid, it cannot be applied. If all advances below 10% of the total advances, the branch should fill the column. Yes, I would say that you are expected to fill that column because you are asked to verify the 5 large standard accounts. 5 large standard accounts and adverse features has to be commented by you. Anyway, that you have to comment and you have to verify. And what is asked in the table is that list out the accounts examined by you. All the accounts which are examined by you has to be listed out. So it need not necessarily that it should be confined to the benchmark account. That is what I requested every auditor, that if you take the list of the accounts which is coming in table number 1 in the LFAR, the total of the accounts which you have verified individually should have at least 75% of the advances covered in the branch. Then only you will have a justification of going to the branch audit next time. It is not for today. It is for the better tomorrow. So we should have to have this particular profession itself to exist. Or I don't say that we are all depending on branch audit now, but even then, if you want to have this particular portfolio to exist, you will have to report all the accounts verified. And now, when you are going to report in that, there is another intricacy that you are dragging yourself the responsibility of having verified that. So in that particular case, what is more important is that you should have the audit documents. You should have the audit working papers. You should have the audit evidences. And whatever judgment you have made has to be properly given in the form of report or in the form of the comment in the LFR. So these are all the things which is to be done at the time of branch audit. So it is increasing the responsibility levels and the working requirement of the auditor. Any other question? Yeah. So for arriving at the deterioration in the security value, both primary and collateral be seen together or no. See, it says that whether there is any substantial deterioration for the purpose of LFAR and for the purpose of IRAC norms, you have to take it into two aspects. For the purpose of IRAC norms, it says that any value of security, total value of security, whether it is primary or collateral together, if there is a deterioration in the valuation security, for more than 50%, it has to be downgraded as doubtful asset. And if the deterioration in the value of the equity is more than 90%, it has to be classified as losses. Okay, that is for the purpose of IRAC. For the purpose of LFAR, on the contrary, it asks that whether there is any significant deterioration in the value of security. So here, significant deterioration in the value of security encompasses both primary as well as collateral. So if you find that there is a significant valuation report of the collateral has reduced substantially, we have found out that NOCs create a lot of problem in respect of valuation. A query is valued for more than around 5 crores of rupees or 15 crores of rupees against which the bank is given loan. But the NOC has been not obtained from the pollution control for the purpose of extraction of the query. Then the value is reduced. There is a substantial deterioration in the value of the security. Take the case of a perishable item, where stock statement has not been submitted for more than 2 months. Take the case of a vegetable. Ooty, we went to Ooty. We went to Ooty and asked for the stock verification. He said that all vegetable merchants or fruit flower merchants. If you want to really see the stock, you have to go by 3 o'clock in the early morning. By 7 o'clock, they will be only cleaning their shop because everything would have gone. So you will have to align it with the business model and with the way in which the business is being done. What is the stock which is being dealt in by the here it is for both primary as well as collateral. What are the points to be reported in the top adverse features? Adverse features, it says that I told you, you are being presented a good person. Take the case of Mr. Rao, very good person. He is being presented in front of you and you are asked to comment on significant adverse features of Mr. Rao. It is not that you just identify, you also want to comment. So what is adverse features? What is adverse features is a matter of wisdom. There are n number of adverse features. Submission, non-submission of stock statement, over trading, your transaction analysis, everything. Your audited non-submission of audited statements. So we have found out that in the case of a company where loan has been sanctioned, it is a software company where loan has been sanctioned, and we did not find any adverse features in that company at all. But we found in the corner of the audit report, printed audit report of the company, that there is a royalty payable to the overseas software supplier after 3 years to the extent of N amount of dollars settled into 3 years, which means that by the end of 3 years, your cash flow payment has to start in terms of dollar for a period of 3 years. So the cash flow after 3 years should be sufficient to meet the requirement of the royalty payment. And we found that the revenue is not matching to that. It's an adverse feature. So we have to use our wisdom. We may get, that is what I am always requesting chartered accountants to be present and involving themselves in the bank audit. If they are involving and if they are going to sit for the bank audit, I think adverse features is not a matter. As a chartered accountant, you are very critical. You can take any number of adverse features from very good things. Now again, installment. If term loan installment paid from CC limit, yes. The question here is that you have got a limit of 10 crores. And the available limit is only 6 crores. And you have got a DP of 10 crores. And you have got a term loan. And if it is taken from the available DP and within the limits, and if otherwise the account is not operated irregularly, and if there is no incipient weakness which you have found out as the auditor, and if the term loan installments are going from CC account, there is no problem. Absolutely no problem. Now the question is that if the DP is only 7 crores, limit is 10 crores, and you are drawing over 7 crores and adjusting this over 7 crores to the term loan account, it is a matter of concern because your DP or your sanctioned loan, whichever is less, is to be considered for the IRAC. Now, as I told you earlier, your COVID loan. If the COVID loan is topped up, it is a fresh loan sanction. And if the fresh loan sanction is used for the purpose of your term loan regularization, it is a matter of regulatory concern. So you have to analyze it in different ways. What is your DP? What is your sanction limit? And if it is within the DP and within the sanction limit, if term loan is paid, and your magnitude is also very important. If the term loan commitments are to the 2 crores loan, and if the term loan commitment is more than 5 lakhs per month, it is not matching. There is a commensurate your comparison issues there. So for a purpose of 2 crores working capital, how can you expect to draw 60 lakhs? That means 5 lakhs per month. It means that 60 lakhs you are draining out of the system for the purpose of your purchase of car. So in 2 years, your entire working capital will be drained out, or in 3 years, your entire working capital will be drained out. So that is a matter of incipient weakness. Transaction audit. So that is what is expected of you to report here. Now, in one general question, many auditors not yet received appointment letters. 2 things I would like to tell you. I cannot go intricately into the independent bankers because the last 3 days before only you have got a sea change in the approach of the IRAC norms itself, because Supreme Court has come out with a verdict stating that your entire IRAC norms, your circular, your stay or which are your verdict which has been given on 3rd September has been lifted, which means that everything goes back to your, so your instruction has to be changed, your banking policy has to be changed, and the lot of if you look at practically, there are merger and demerger happened in a very high scale during the year 2021. So the requirement of the branch auditors has to be intimated by the bank to the RBI. I want category 1 auditors this much. I want category auditors 2 auditors this much, because according to the loan profile. And again, they will say that I want this much auditors in Bombay. I want this much auditors in this state. So the branch profile, your demographic profile, everything has to be given, and it will be aligned and given to the Reserve Bank of India. Reserve Bank of India then give the list. So it takes some time for the purpose of finalizing all these things. Don't worry. Anyway, the good news is that by all means, 99.9% your bank audit fees is going to be increased substantially for 2021. So, so that is a good news.
Good news.
Srinivasa Rao. Yes, sir. Now, how to check current accounts with the other banks, CCOD accounts? Very simple. See, if you go to the transaction audit, point number 1. If you go to the transaction audit, you find that frequently there is a incoming and outgoing from a particular current account. You have to find out whether the current account relates to the borrower, whether the current account relates to the customer, or whether the current account relates to any other person. Second is that if you go to the audited balance sheet of the company or the audited balance sheet of the borrower, you find that other than the CC account, you have got another 5 accounts which is maintained with various banks. And if those banks accounts and transfer and transaction is appearing in this account, that is another way of looking at it, another way of pointing at it. 3 is that if any NOCs has been obtained from the main bank for the purpose of availing a loan from the other bank, it is a matter that there is account with the other bank. If EMIs are going from your account to another bank, it is a matter that you are having account with the other bank. So it is very simple. As I told you earlier, if the case, many of the retailers, what they will do is that they will find a nearest branch, nearest bank for the purpose of depositing their cash. And this will be transferred to the account where the CC account is maintained. It will happen in Mumbai, if you want to happen in all metro cities, that if I am having a small shop, if I am having a retail shop, take the case of a petrol pump. A petrol pump will have an account with the smallest bank or nearby bank. And all the deposit of cash, 2 lakhs or 30 lakhs or 40 lakhs per day will be deposited. And every day the transfer will take place because he doesn't have to take the risk of carrying physical cash to the main branch. So if you look at the petrol pump profile, as I told you earlier, when you do the transaction audit, you have to see that the debit side is all cash deposits. If it is coming as bulk transfer, it is a matter of inconsistency. It is a matter of opening an account with other bank. So there are a lot of ways of looking at it. And if you go deeply involving into the bank audit, you will be able to understand all these things. Sir, generally borrowers audits year and 31 contemplates the audit of August, September. So borrowers audited accounts, yes, I would say that not available may not come because for the purpose of your 2021, what is more important is that you will have to apprise the financial statements, audited financial statements as on 20. So 20 financial statements invariably would have been completed by all means in respect of a genuine borrower, in respect of any genuine business. your 20 balance sheet should have been completed by all means, because your tax audit date is over, your return filing date is over, your GST date is over, all these things are over. So by all means, your 20 balance sheet should be ready. If at all it is not ready, you can obtain a provisional balance sheet and you can go into the details. Even otherwise, you have got a lot of other ways of looking at the turnover. You can go to the GST. You can go to the GST portal. You can go to the what you call income tax site, and you can find out. Even if you draw the 26 as, you will get what is the turnover. Now 26 as is the mantra for every transaction of the borrower as a whole. In 26 as, if you look at the 26 as, there is a 3B whatever is given in the GST tenor is there. So there is no requirement that you should be able to get the audit accounts alone. You can get the audit, I mean, the sales tenor, etc., from any of the other parameters also. Now, I think I have answered the questions also almost in the right manner. Now, only time was the constraint, but anyway, I'm very happy that everybody was there, attentive, and be there for more than around 2.5 hours. Thank you very much for the opportunity given. Rao Saab, I should again thank you for inviting me to Hyderabad branch. Again, very longing to meet all of you physically in Hyderabad. And Sadish sir, thank you very much.
Thank you. Thank you.
And we will definitely get a chance to meet physically also. And it is all a nice experience to meet all the chartered accountants across the country and discuss about all these factors, especially the person who has introduced me. Very nice introduction he has done about me. Thank you very much, all Hyderabad.
Thank you, sir. Thank you so much for your acceptance, and we are so very much grateful for your efforts and time and effort, sir. Your presentation shows your experience, exposure, command on subject. It's really great insight towards subject and a lot of value addition before the bank audits. And the person who is introduced is our past chairman, Y.V. Banu Narayan Rao. He is also experienced like you, sir. Looking forward to your continuous support for an Hyderabad branch and branch members. And sure, sir, we would like to meet you physically once everything is over. I request you to come Hyderabad for giving one more session here. And once again, thank you, sir, for your accepting our invitation and sharing your expertise and knowledge. And as a token of thanks from Hyderabad branch, we would like to request you to accept our virtual certificate of appreciation.
Thank you, sir.
Thank you, sir.
Yeah.
Thank you so much.
Thank you, Chairman sir. Thank you, Manish sir. Now I am requesting CA Y.V. Banu Narayan Rao sir, past chairman Hyderabad branch, to give closing remarks for the day.
Yeah, before that, Satish Garu, I would like to recognize the presence of our most senior chartered accountant Sundar sir and our Jawar sir. Thank you, sir. Thank you so much. Sir and Jawar sir is almost there from the starting.
In fact, I would tell you, Rao Saab,
sir.
Sundar Saab, I was looking at only Sundar Saab and speaking because he was the only person who put the video on, and all other people have put the video off. See, the beauty of virtual audit is that for the listeners,
Sir.
it is flexible, but for the speaker, it is not at all flexible. But in the case of physical, for the listeners, it is not flexible because you cannot look at the speaker and get away from the hall. But for the speaker, it is very easy.
Yes, sir.
Rao
Satish Garu, before that, a small announcement.
Rao Garu,
tomorrow's program.
I'm Sundar here.
Yes, Sundar sir, please.
Rao Garu.
Sir, please, sir, Sundar sir.
Hello.
Sorry, audible sir. Tell me, sir.
No, just only 1 minute.
Sir, please.
In fact, I was talking to Kozhikode, Calicut a couple of days back, and I was talking about Mr. Moni, and I was told I could not miss his lecture. So I really loved his lecture, and I'm telling you, excellent. Not that God bless him, and we should, to the best of our ability, to invite him to the maximum possible.
Sure,
Thank you
sir.
very much, sir. Moni sir, I regularly come to Guruvayur and I come to Calicut.
Oh, please meet me, sir. You can call me and you can meet me.
Oh yes, sir. Oh yes.
I think on the back of you, it is Tirupati Venkatachalamati, because again I was looking at Venkatachalamati also and praying when I was speaking.
Thank you.
I thought that it was Guruvayurappa. Then
No,
only
no.
I identified that it is Venkatachalamati. Yeah.
No.
Right.
Thank you, sir. Bye.
Thank you, Sundar sir. Thank you, sir.
Banu sir, we want to hear from you.
Program, sir. We have some panel discussion, sir, with our senior here, Jawar sir and Venkat Janakinath sir, and our Sundar sir, and his partner Ranganathan sir. and Vijay Srinivas Garu from technology side. We have very good panel discussion, which is generally we are doing from Hyderabad branch from every year, sir.
That is very good.
To clarify all the practical questions of issues of our members.
Very good.
So
Okay.
request our members sharply join by 9:30 tomorrow. Thank you, sir. Thanks for.
Thank you, everybody.
Thank you all the delegates for your active participation, and your active participation will encourage us to conduct more and more programs. Thank you all. Over to Satish Garu and Banu sir.
Yeah, Banu sir. Now we want to hear once again beautiful words.
So what more can I add to the words of Sundarji? Sundar sir is a very well-renowned chartered accountant, senior chartered accountant, and expert in bank audit. And every year, Hyderabad branch always looks to him for his words of wisdom to be shared with the members of Hyderabad branch. And Sundar sir has summed up very well about what Mani sir has spoken today. And sir, hats off to you. And as you rightly pointed out in his virtual sessions, the listeners have some flexibility, but we, the panelists, we switch off because of bandwidth problems, sir. Not that we are doing something else, but we just wanted to clarify that our last year chairman has given us training and instructions that we should be always available whenever the speaker is taking the session, because any moment he may have any requirement. So all of us will be there, but only thing is we go into we switch off the audios as well as the video, because we don't want to have any disturbance, and also we don't want to have bandwidth problems. Because sometimes what happens is when all the speakers are on and all the videos are on, there will be disturbance somewhere or the other. That is the only reason, sir. But otherwise, we are all present. And
yes, sir, we are here only, sir.
It was only a lighter way that I told. Okay.
Yes, sir. I understand.
Thank you.
Thank you very much, sir. And another thing is, you have raised this point of repayment of term loan and car loan installments. People have the habit of buying Benz cars and BMWs, and they keep paying the installments from out of the CC limits. This point has been discussed many times amongst our CA brethren, whether it is a diversion of the limits or whether it is permissible. So you have explained it, given it more clarity that if it is everything is within the drawing power and the sanction limit and there are no inherent weaknesses, you have said that it should not be an issue. But tomorrow I request Sundar sir to take up this issue suo moto, and tomorrow even if somebody doesn't ask, anybody wants to ask, or even if somebody doesn't ask also, maybe you can give a little share your thoughts on this subject, sir, because this is going to be a continuous discussion even for our CARO reporting and the latest Schedule 3 amendments. So whether we can treat it as using of funds for some other purpose, or whether it can be treated as normal. So we would like to listen to you, sir. Mani sir, thank you very much once again. Hope to see you again, and many dhanyavads. And with your clarity that you have given, I think we'll have a very good experience in having a real long form audit report instead of yes, no, not applicable. We will be giving the clear opinion, and we will be giving a report in a real sense of a report. Thank you so much. Thank you, Chairman, and thank you, Secretary, for giving me.
Yeah.
Thank you,
Banu sir. On behalf of Hyderabad branch of ICI, we thank speakers of the day, CA Dhananjay Gokhale sir, CA Boriji, for their wonderful and practical oriented presentation. Sir, we are really thankful for accepting our request to address us. It's really happy for all of us, you to be a speaker. We also thank CA Machara Minvalli, branch chairman, Hyderabad branch, CA Deepak Bhai Ladda, vice chairman, CA Rajambal, treasurer, CA A. Sitaram Reddy, Sikasa chairman, CA Pankaj Bhai Trivedi, immediate past chairman, CA Bhanan Garu, past chairman, other members. Friends, as you all know, for your information, we are meeting again tomorrow morning at 9:30 a.m. We sincerely all the participants for taking out your time and attending today's seminar. With this, I am signing off for today, and we will relook into again tomorrow at 9:30 a.m. Thank you.
Thank you, Chairman sir. Thank you, Sundar sir.
Thank you.
Thank you, Bhanu sir.
Thank you.
Thank you, sir.
Thank you, delegates. Thank you.